I, Donald John Trump, do solemnly swear
I, Donald John Trump, do solemnly swear
that I will faithfully execute
that I will faithfully execute
the office of President of the United States
the office of President of the United States.
The golden age of America begins right now. I will declare a national emergency at our southern border to defeat what was record inflation and rapidly bring down costs and prices. We will measure our success not only by the battles we win, but also by the wars we end, and perhaps most importantly, the wars we never get into.
The first item that President Trump is signing is the rescission of 78 Biden-era executive actions, executive orders, presidential memoranda, and others.
Well, we're thinking in terms of 25% on Mexico and Canada. I think February 1st.
Are you planning on keeping notes of that?
I think we'll do it February 1st. So this is January 6th. These are the hostages. Approximately 1,500 for a pardon. Yes. Full pardon. I think the U.S. should be entitled to get half of TikTok. And congratulations, TikTok has a good partner. America will be respected again and admired again.
Welcome to Yahoo Finance's special coverage of President Trump's first full day in office. I'm Shonda Smith alongside Brad Smith. Well, stock futures are higher following President Trump's first executive actions. The president rescinding 78 executive actions implemented by the Biden administration, also signing a flurry of executive orders. Now, those include declaring a national emergency on the southern border, moving to end birthright citizenship, withdrawing from the Paris Climate Agreement, and declaring a national energy emergency. Also on the list, directing federal agencies to investigate trade practices, delaying enforcement of a TikTok ban, and implementing the Elon Musk-led Department of Government Efficiency. It's important to note some of the executive orders are likely to face legal pushback. Now, the president did not announce universal tariffs, but did suggest a 25% tariff on goods from Mexico and Canada starting February 1st.
We did see some whipsaw action in the markets around that commentary. Futures were initially under pressure around tariffs. Currently, we are seeing stock futures right now advance an hour ahead of the opening bell. Investors seemingly relieved by some of Trump's softer than expected tone around tariffs more widely. The dollar is up against both the Canadian loonie and the Mexican peso. We're also seeing crypto cooling just a bit here. Markets were expecting some kind of pro-crypto policy announcement, and that failed to materialize. President Donald Trump signed dozens of executive orders on his first day back in office addressing inflation, energy, immigration, TikTok, and more. Joining us now to discuss these policies, we've got Brian Gardner, who is the Chief Washington Policy Strategist at Stifel. Brian, good to have you here with us. We want to start with Trump's plan to tackle inflation, specifically high energy prices. We want to play this clip for you and get your reaction on the other side.
The inflation crisis was caused by massive overspending and escalating energy prices, and that is why today I will also declare a national energy emergency. We will drill, baby, drill.
And there you heard the comments from the president. Brian, I just want to get your reaction here and the declaration of the national energy emergency, the significance of that.
Well, it's part of the deregulatory agenda that he's bringing in that we all expected. I don't think there were any surprises on the energy side yesterday. I mean, to use his phrase, it's drill, baby, drill. I guess the question is, and this is an open question, is it will, baby, will, in terms of are oil companies, energy companies going to do more exploration and production? And I think a theme you will hear from companies, I don't cover the sector, but I think the theme you hear from the companies is conservative, cautious capital deployment. So I think there is a policy in place. It doesn't mean necessarily we're going to see massive new production exploration that are going to lead to a drop in oil prices. As a matter of fact, oil prices have been up since the election, moving around a little bit the last couple of days, but generally in a upward trajectory.
Brian, what did you make of the tone and rhetoric surrounding inflation, plans to bring down prices? Talked about it in his inaugural address and mentioned it once again in the Oval Office. Just in terms of that being such a priority, how realistic are some of the goals that he has laid out?
Shawna, this is the great conundrum for the Trump administration. They ran on and won in a big part to the battle over inflation, the debate over inflation. The frustration among voters, especially modest income voters that have become a big part of the Trump camp, Trump base, frustration over higher prices. And in one of the clips you played earlier, he's talking about lowering prices, not just getting rid of inflation, bringing it back to a lower level, but price declines. That runs headlong into the tariff debate, which does increase prices over time. I think, I don't know if you guys want to get into the TikTok debate, but I think that's a signal. I think that the TikTok announcement signals that when a policy runs into the problems that it's against what his base wants, TikTok being younger voters, that you're going to see some flexibility from the Trump camp. And so even though we got that announcement last night on 25% tariff on Canada and Mexico, I'm looking for some flexibility. Is it going to be 25%? Are there going to be sectors that are going to be exempt because particular sectors impacting his base more than others?
Just since you mentioned TikTok, let's stay there for a hot second here because, sure. I mean, it was a ban that lasted essentially less than a holiday weekend. And now there's going to be more of the legal question mark about what authorities he has in order to overturn a Supreme Court decision that actually backed the basis of national security, which was something that President Trump in the 1.0 of Trump had brought forward previously.
Yeah, so I mean, people with longer memories will go back and you can find the clips where Donald Trump was fully supportive of banning TikTok in the U.S. 2024 comes along, TikTok becomes a useful tool to the Trump campaign. They bring in younger voters that they may not have reached otherwise, and he has shifted on that. On the legal side, look, I think you can make a very good argument that the delay that he has imposed runs counter to the statute as it's written. The question is, are you going to get somebody to sue, and is that lawsuit going to get through the courts in time before there's some resolution? I'm kind of skeptical on that. I think the Trump delay stays in place, and we'll get a resolution at some point without the courts really affecting that too much.
Brian, I want to stick with the geopolitical side of things and talk a little bit more specifically about tariffs, because that was a huge thing that came out yesterday. At first, or I think you can still say the market's taking a bit of sigh of relief, the fact that we didn't hear more hawkish rhetoric when it comes to China. But again, when it comes to the tone and what he had to say about Mexico and Canada and some of the plans there, I want to play a quick clip of what we heard from President Trump yesterday.
I will immediately begin the overhaul of our trade system to protect American workers and families. We are establishing the External Revenue Service to collect all tariffs, duties, and revenues. It will be massive amounts of money pouring into our Treasury.
Brian Goldman was out this morning with a note saying that it's clearly not as bad as feared, lowering the prospects here, obviously, of universal tariffs. What do you think the market's biggest takeaway from some of the comments that we heard from the Trump administration should be this morning?
I think the takeaway should be that we're going to be on a roller coaster ride for the next couple of months. I mean, look back to Trump 1.0. And I think you can say the new boss is, meet the new boss, same as the old boss. It's going to be bumpy. He's going to say things. He does not have a filter. We saw that in the White House last night. And look, a lot of people are going to like that. They find it refreshing. But for investors and for markets, you have to know that we're going to go in multiple different directions. There are competing camps within the Trump White House. There are more traditional Republicans who tend in the free market direction more than others. And they're going to be competing for the president's ear. And so you're going to get multiple narratives coming out of the Trump White House at any given time. So I guess the message for the markets is buckle up. We're in for a bumpy ride over the next few months.
All right, Brian Gardner, thanks so much for taking the time to join us.
Thank you, guys.
Well, futures are rising this morning as President Trump's second term begins. The move higher coming despite the president's proposal for 25% tariffs on Canada and Mexico next month. I think overall the market may be breathing a bit of a sigh of relief here just in terms of what we got here on tariffs. Let's bring in Michael Reinking. He's NYSE's senior market strategist. And Michael, I'm curious how you would sum up the tariff commentary and maybe what investors are focusing on this morning ahead of the opening bell.
Yeah, so I mean, I think you and Brian just kind of touched on it, right? There's a lot of mixed messaging coming, right? So the expectation that we were going to see kind of wider spread tariffs initially, that led to some relief. We did get the commentary on Mexico and Canada overnight. But it's also interesting if you look at some of the trading action this morning. If you look at the automakers, right, they're all trading higher in the pre-market, despite the fact that they they import so many cars from those regions, right? So there's a mixed response. It tends to lead to the idea that markets don't necessarily believe the 25% numbers, right? And they're kind of discounting a lot of that, I think, at this point.
What is the kind of, you get back to the floor of the exchange today and you speak with some of the other traders. What do you think the trade is that emerges in their minds if we do see some of the tariffs that are starting to be kicked around, talked about a little bit more, and have numbers tied to them? What is the trade that they talk about and are looking to engage with? Yeah,
so I think at this point, markets are working off of that assumption that they're being used as a negotiation tool, right? So I think the risk is that they're actually implemented, right? So if you think about President Trump's commentary between now and then, he's always, if it is a negotiation tool, he always has to carry that big stick, right? So he's always, no matter what you hear in the press, he's always going to come out and kind of and call that fake news, so to speak. But I think that from a market perspective, right, if you actually start to see some of these tariffs instituted, I think that's where you're going to start to see kind of the inflation side of things, kind of potentially start to perk back up. And I think that's where kind of the risk is, and partially what we've seen, kind of within Treasury markets in some ways. But I don't think we've discounted that risk at this point.
Michael, putting tariffs aside here, because I think it's fair to say that is probably the focal point here for the markets when it comes to Trump policies. But what is that next policy initiative that matters most to the market?
Yeah, so I mean, it's really the sequencing of where we go from here, right? And that's still very much up in the air, right? So we're seeing kind of the initial move on immigration. It seems like he's kind of pushing tariffs back a little bit, right? Which leaves the door open to get some of the pro-growth policies put in place first, which I think is how they would like to see things go, where if you put in some of the pro-growth policies earlier on, right, then you come back with some of the policies that are a little kind of less market friendly, right? It gives you a little bit more of a buffer to move from here. So I mean, the discussions around tax cuts and that's going to kind of be a big topic, kind of moving forward. And it's just going to be difficult, given the very slim margins in Congress, to move a lot of these policies and kind of Trump's agenda forward.
Is the easiest way to boil it down is that the markets are trying to best get a gauge on what is going to be most inflationary and thus rattle the Fed's pathway forward that they've already communicated to this juncture?
Yeah, that's definitely a way to look at it, right? I mean, I think just the policy fog, right? And that's not my term. I think I forget who actually kind of coined it.
We were talking about fog earlier this week.
I was talking about fog.
A lot of it.
Right, but I mean, there's a lot of policy fog at this point, right? And the Washington policy is going to impact the monetary policy, right? And so understanding kind of where we are, from that perspective is going to be sort of difficult. But if the way I think about things is, we're not going to see the impact of policy put in place for some time, right? Like, so if you think about it, as we work through this, and it's going to take a couple months to get anything kind of actually moving, right? That puts you kind of with some lagged effects to that. That puts you towards the back end of 2025 till you really start to see that impact economic activity. You'll see some pull forward of demand, with the expectation that you'll see some protectionist policies, right, and things of that nature, right? But you're not going to really start to see it impact the economy. So that leads you back to kind of where you were last year, where we have a very positive economic backdrop, right? You do have a Federal Reserve, which is on hold, but just listening to what we've heard from them in the past week, And during even Chair Powell's press conference, they still are telling you that they want to kind of cut rates, right? But they just have to kind of see things work out. So the overarching backdrop is still pretty positive, and then you're starting to potentially see an inflection higher in earnings.
Pretty positive economic backdrop is far different from national economic emergency that we have heard from the now President Trump. Michael, thanks so much for taking the time.
Thanks, guys.
Today. Appreciate it. Coming up, everyone, we're going to head to Davos for a look at the global reaction to President Trump's inauguration. That is next on Yahoo Finance.
The World Economic Forum is underway in Davos, Switzerland, and top of mind is Trump's return to the White House as business leaders and policymakers plan for the next 4 years. Jennifer Schomburger is on the ground with a look at some of the international reaction that we're seeing to Trump's inauguration. Jennifer, what are you hearing?
Hi, Shauna. Here on the ground at the World Economic Forum in Davos, global policymakers and executives are reacting to President Trump's policies. JP Morgan executive Mary Erdos spoke this morning on a panel. I asked her how JP Morgan is viewing Trump's policies, from tariffs to tax cuts and the potential economic impact. She told me that JP Morgan has set up a war room and that folks have been up all night analyzing the potential impact on the economy. She says that JP Morgan thinks his policies will create a, quote, very pro-business environment. She told a panel that animal spirits are alive and that the bank is confident that the new Trump administration will take a lighter regulatory touch to banks, something they say will unleash lending and economic growth. Meanwhile, both China and Europe struck a conciliatory tone when it came to trade. European Commission President Ursula von der Leyen said when it comes to global trade, quote, a lot is at stake for both sides. She said Europe's first priority will be to engage early, discuss common interests, and be ready to negotiate. She says we will be pragmatic, but we will protect our own interests. Given that Trump has said that he will scale back U.S. support of Ukraine, she said that Europe will stand by Ukraine for as long as it takes. Meanwhile, China's vice premier said that imminent trade wars and an ongoing tug of war for and against globalization is something that is taking hold, and that he hopes that, quote, the sun will break through the clouds. He is calling for cooperation to create a stable environment, saying that protectionism leads nowhere. Trade wars have no winners. Meanwhile, a Chinese economist from the London School of Economics spoke this morning at the forum, and she said she believes that China's response to U.S. tariffs may actually be more muted given the state of China's economy. Guys?
Jennifer, thanks so much. Appreciate it. And for more from Davos, stay with us on Yahoo Finance. We will have the Cloudflare CEO, Matthew Prince, joining us live during Catalysts today. One of President Donald Trump's first policies on day one was to officially establish the new Department of Government Efficiency, known as DOGE, saying in his inauguration address, the department will, quote, restore competence and effectiveness to our federal government, end quote. Joining us now on this, we've got Doug Holtz-Eakin, who is the American Action Forum president and former director of the Congressional Budget Office from 2003 to 2005. Doug, thanks so much for taking the time here with us this morning.
Pleasure.
What can DOGE realistically get done from your assessment?
Well, I think this is a very interesting development. For months now, we've been hearing about DOGE, and it was really just a couple of outsiders opining on what the federal government should look like. Didn't really have any authority. With this executive order, the president has essentially renamed the United States Digital Service and given it a task. The narrow task appears to be to modernize technologies in the federal government. Seems like a sensible task for an Elon Musk. And there is language in there that says it will not have any budgetary authority. It will not step on the turf of the Office of Management and Budget, which will be the regulatory domain. So DOGE seems to have a fairly narrow mission in this executive order, and it's nothing like the sort of grand schemes that we've been hearing.
So when it comes to, I guess, the effect of DOGE, has that then very much, it's safe to say, been overstated? And I guess going back to what Brad just said, just in terms of how to be a little bit more realistic maybe about what might come out from that, what should investors then have on their radar?
I have been for quite some time a DOGE skeptic because they don't really have any authority. And what they have is the bully pulpit. Elon Musk and previously Vivek Ramaswamy talking about what would be a good idea for OMB to do, what would be a good idea for the Congress to do, but nothing that they could actually do. This now looks to be a much smaller bully pulpit. So I don't expect to see DOGE deliver anything dramatic in terms of the scale of government spending. The claims of losing $2 trillion from the federal budget don't seem realistic to me. And quite frankly, the Office of Management and Budget has a great track record from the president's first time in office on controlling regulatory costs. I expect to see that again, but that won't depend on DOGE. So, look for a pro-business environment that is driven by a light regulatory touch and, some control over budgetary outlooks, but not from DOGE.
What does light regulatory touch and perhaps the baseline expectations for regulatory instances or regulatory reform even in the way of thinking under the Trump administration 2.0 look like from your seat?
So the magic the first time was to just tell agencies, look, here's how much of a burden you can impose on the private sector in a given year. And that's a regulatory budget. And most of the budgets were zeros or negative numbers. And I was quite skeptical they could do that, but they were very successful in hitting those targets. I expect them to do the same thing again, give the Department of Interior, the Department of Energy, the Department of Health and Human Services a budget that says you can do regulations as needed, but the total cost can't be bigger than X. And if it gets bigger, you have to take something else off. And so the light touch comes from the agency being really incentivized to find old regulations that are costly to businesses, but which aren't delivering anything, and pull them out. That was they were really making great successes on that front when he was in office the first time. I expect to see more of that this time around.
Doug, when it comes to some of the priorities here from the Trump administration, they're trying to get a tax deal done very early, just historically speaking, just in terms of how quickly they want to move on that. You're also talking about the debt ceiling. They want to get that extended. How, I guess, not to use the word realistic again, but how likely is that, just given the very narrow margins that we do see right now within Congress and some of the pushback that we could see even from those within his own party?
I think you've said it quite clearly. I mean, this is really hard. They have to first pass budget resolutions in the House and Senate and then agree on what they look like. That will take some time, and the margins are narrow. You have to run the table. Then they have the actual reconciliation bill itself, which will have to go through the House and Senate, and they'll have to agree on what it looks like. And again, margins are very tight. You have to run the table, and you have to get some real divisions, especially in the House, somehow resolved in order to get essentially a unanimous vote out of Republicans to pass that. That doesn't sound like something that happens quickly. The debt limit, that timetable is not under their control. They're going to have to do it when it becomes an imperative. There's no question about that. They're also going to have to fund the government. By the way, the Senate's going to be busy confirming nominees. And so there's a lot of work to be done. And it looks to me like the optional part, the tax bill, which is in reconciliation, is going to get pushed to the back of the line on a number of occasions.
Doug, how likely is it that we see the party actually disrupt itself then on the way to what has been promised on the campaign trail? Because now, even given the red sweep that we had seen during the general election, there's more of a thinking around, okay, where will there be continued combined consensus among the party, or where will some members break along the way to reaching some of the goals that had been set forth or at least communicated to voters?
I think it would be a mistake to believe that Republicans are a unified bloc on any policy issue. That's never the case. It's not true for Democrats either. And so they're going to have to mediate differences. On the campaign trail, no one talks about differences. We're all on the same team. We're going to do this. We can do it fast, enact the president's agenda. But what happens to the cap on state and local taxes, for example? Does it stay the same? Many people want it to go up. That's a very costly item. Not everyone wants to have bigger deficits. How do you compensate for that? When you get down to the details, the differences emerge. And to get through the House, especially with tight margins, they're going to have to find ways to get everyone on board, and that's going to be a hard task. That's literally the nuts and bolts of legislating, which is very different than campaigning.
Doug, always great to get your insight. Douglas Holtz-Eakin, thanks so much.
Thank you.
Before we head to break, let's get a quick check of the markets. You got futures rising across the board for the three major averages. We're going to have much more coverage coming up ahead on Yahoo Finance. It's 9 a.m. here in New York City on this Tuesday morning. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you guys the three things that you need to know today.
Good morning, everyone. First up, Donald Trump sworn in as the 47th president of the United States.
The golden age of America begins right now. I will declare a national emergency at our southern border to defeat what was record inflation and rapidly bring down costs and prices. We will end the Green New Deal and we will revoke the electric vehicle mandate. We are establishing the External Revenue Service to collect all tariffs, duties, and revenues. We'll establish the brand new Department of Government Efficiency. America will be respected again and admired again.
Within hours of the inauguration, the president started signing a flurry of executive actions, from declaring a national emergency at the southern border to leaving the Paris Climate Agreement and delaying the enforcement of the TikTok ban.
Plus, stock futures pointing to a higher open. Investors relieved to see an overall softer than expected tone from Trump on tariffs early in the day. However, we did see some volatility following his comments from the president.
Well, we're thinking in terms of 25% on Mexico and Canada. I think February 1st.
Are you planning on keeping notes of that?
I think we'll do it February 1st.
And crypto is under pressure this morning. The market was expecting to hear some kind of pro-crypto policy announcement from the president, and that failed to materialize. Bitcoin is pulling back after hitting a record high on Monday. As we head into the first trading day of Trump's second term as president, our own Josh Schaefer is here with a look at the top three economic issues that investors should be watching. Josh, what are you watching and what should investors be paying attention to?
Yeah, Brad. So I kind of broke this into just like three key things that we're watching this week, right, that could impact stocks kind of in the short term here. And I think it breaks into really just markets reacting to Trump, as you guys were just sort of laying out. We saw the dollar ease off a little bit, as we've talked about, perhaps less tariffs coming in than we initially thought. We also have seen bond yields start to come down in the last week. Is that going to continue, right? Are we going to see this continued lowering in rates as we talk about the different variations of Trump's policies? Or does some of the things that Trump says and Trump actually puts into action give us a rise in rates? And we know that's been a key headwind for stocks over the last couple of weeks. And sort of the last thing here, guys, that I think is key is right now we've been pacing pretty well with earnings. It's very, very early in earnings season. But after most of the financials reported, S&P 500 earnings have been doing slightly better than expected. That's been a good story for the market. The key question is whether or not the market can really focus on that right now, right? I think Citi equity strategist Scott Kroner put it well in a note to clients. He said short-term markets will have to contend with building fiscal, trade, and monetary policy uncertainty, even if earnings reports are solid. Putting it simply, guys, there's a lot going on right now that is not just company earnings. We have a Fed meeting next week as well. Feels like a lot of macro where we're not going to really maybe be focused on the micro of earnings. So perhaps maybe a little bit of a unsteady start to President Trump's second term in office for the markets.
Lots of uncertainty here ahead. All right, Josh, great stuff. Thanks. Well, the era of Trump 2.0 has begun, and though risks of reigniting inflation do persist, President Trump is inheriting a U.S. economy that's in pretty good shape. On his first day in office, President Trump injected some uncertainty into that backdrop, though, signing the most day one executive orders in recent history. Joining us now, we want to bring in Mohammed El-Arian. He is the president of Queens College at Cambridge University, also chief economic advisor at Allianz, also alongside market domination co-host Julie Hyman. Mohammed, it's great to have you back here on Yahoo Finance. I'd love just to get your first reaction just in terms of some of the market implications, economic implications from the executive orders that were signed yesterday.
Thanks for having me on. The market wanted to treat yesterday like drops Friday or the CPI date, which is an event risk, and you get the information and you move on. What the market is realizing is that this is much more dynamic. This will go on for a while. And you mentioned what happened in the FX market. That was fascinating because on the first set of trade-related comments, the dollar weakened quite a bit. Then we got the second set a few hours later, and the Mexican peso depreciated, the Canadian dollar depreciated, and the dollar regained half of what it had lost. So the message is this is not a one-day event risk, both upside and downside. This is something that's going to remain with us. So far, the market likes what it has been hearing, but it's early days.
Mohammed, your point is well taken. This is just the beginning of what could be a long 4 years for the markets. In the next, say, 100 days, obviously that's usually a period that people watch closely. What are you going to be watching most closely? What's going to be most pivotal for markets?
So 5 areas, some we know already. So energy is really important. And that we've heard a very clear message from the president about drilling. Immigration is a second issue because that impacts the labor market. And to what extent are we going to see the repatriation of illegal immigrants? And how does that impact the labor market? So that's the second one. Trade, of course, and we are early days. If anybody in China or Europe is relieved, I tell them just wait. It's early days. So we need to see what happens on tariffs, deregulation, and fiscal. So 5 areas, all of which have a significant impact on earnings, on the economy, and will influence how the market behaves.
Mohammed, you recently wrote in the Financial Times about many things, among them that one of the things that propelled Donald Trump to this second term as president is sort of the economic dispersion in the United States. The idea that the economy, as we showed coming into you, is on pretty good footing, but it did not benefit everyone equally. From what we have seen from this administration in the first day and from what you're expecting, do you think that's going to change? Do you think that the measures that Donald Trump is expected to implement are going to go to the heart of that issue that got him into office?
Yeah, I mean, the issue of dispersion, or what a lot of people call the K-shaped economy, where the rich are doing better, but the poor continue to struggle, that was very well understood by President Trump. And that is the reason why the electorate didn't appreciate the economic exceptionalism that everybody talks about, that is strong U.S. growth, because the benefits of that growth were not shared widely. And if you're at the bottom of the household income distribution, you've run down your pandemic savings, you've maxed out your credit cards, and you're insecure, you're financially insecure. President Trump understood this much better than the Democrats. The Democrats were never able to address that issue in a manner that allowed them to get credit for the overall economic performance. So there's full awareness in the Trump administration of this issue. There's a promise that they will address it. And that's why the details of the fiscal are going to be so important, as will other parts of the policy. But it is fully understood by President Trump because it has helped propel him back to the White House.
And so what we've heard, Mohammed, is that there will be a golden age of America. Will that golden age of America then extend into the income cohorts that have not felt like they've been in a golden age, even if we do see an extension of the Tax Cuts and Jobs Act in a 2.0 fashion?
It must. If we are going to have a golden age, there has to be better trickle down, and I hate that word, but better trickle down to the low income people. You cannot run an economy with K-shaped characteristics for a long time. Just like at some point, we have to worry about the bad and the ugly of the global economy. You've heard me say this. The good of the global economy is the US. The bad is China. The ugly is Europe. These are the 3 major economic areas. And there's massive divergence as well there. The US is outpacing the other 2. The IMF revised its global economic outlook for 2025. Guess what? It took the US growth rate up by 0.5 percentage points. That's an enormous amount for a large economy. And it took down Germany and France. So these 2 issues are going to be key. One, can he address internal diversion between the rich and the poor? And 2, can he convince China and Europe to get their act together so that we don't get this external dispersion? Because either we're going to level up the global economy or we're going to level down the global economy. And leveling up is a hell of a lot better than leveling down.
Mohammed, what strategies then should investors adopt then in response to that economic divergence? And where does that leave the U.S. relative to the rest of the world?
So I think you need to embrace 3 things. One is volatility. this is going to be a volatile year because of all sorts of things going on. The second is dispersion. Take dispersion seriously. We're going to see it across countries. We're going to see it within countries and also within sectors. And then the third element is to understand that we've gone from an investment approach that was market-based to a second one that was theme-based. And now we're going to much more name-specific based. And that's really important because if you're simply a passive investor, you didn't gain much when we went from market-based to theme-based, but you're going to lose even more when we go from theme-based to name-specific.
So that implies then that this needs to be an age of more active management, more of a stock pickers kind of environment?
Yeah, in a perfect world, it's much more active manager, it's much more name-specific. If you can, and many cannot, you should combine public with private opportunities. In private opportunities, you can structure exposures much better. So this is going to be increasingly building portfolios from the bottom up and not just from the top down.
And what does it imply? You were just talking about how the U.S. is still on the strongest footing. There has been some increasing chatter, though, about whether investors maybe should be looking elsewhere, either to developed or emerging markets. For example, this morning in the Wall Street Journal's Heard on the Street column, they talked a lot about valuations and the gap between the U.S. and the rest of the world is at an unusually wide level, right? And maybe that creates some opportunities. Do you think that's how investors should be thinking about it also?
Julie, I'll give you the same answer I've been giving you for years. It will be at some stage, but it's not now. There's a reason why we've had this valuation gap. The US is a much more dynamic economy. Its growth is outpacing other major markets. It controls more of its destiny. It's not as vulnerable, Europe, for example, to energy issues. It's not as vulnerable to emerging markets, to currency moves. And then finally, ask yourself, who is investing in the growth drivers of tomorrow? Who is seriously taking AI, life sciences, defense, healthcare? Most of the investment in that is happening in the US. Why? Because it's led by a handful of large companies that are US companies. So when I look at all this, yes, valuation differences are large, but I suspect they'll get larger before we start having the convergence trade that people have been calling for, as you know, for years now, and it hasn't been a good call.
Mohammed, you mentioned the active management, the perhaps stock picking even of some of the winners and themes that investors should be leaning further into. But does that, and after we had seen some of the tech CEOs that had exposure in one form or another to generative AI and their companies' investments there, does that mean that there's going to be a deceleration in the type of return that we see from some of the generative AI or AI-focused companies that have had a lot of capital to deploy and investors being able to just kind of set it and forget it into those stocks?
So I think we're still looking at positive returns, but not as positive as what we've seen. There's an old phrase that a friend of mine at PIMCO used to say, you can't go to heaven twice on the same deed. So, the markets have understood the amount of innovation going on. They've understood how impactful that's going to be for productivity. And there's been a ton of money that has gone there. So it's become a bit of a crowded trade. However, it still has upside. And I think more generally, we've had 2 years of returns of over 20% for the S&P. I think we have to be realistic that it's not often that you get 3 years of over 20%. I think the prospects are still good, but we shouldn't be hostage to 2 exceptional years.
Mohammed, I also want to ask a little more about the U.S. dollar. Because obviously, as you mentioned, currencies have been very reactive to the headlines about tariffs. And sort of underlying that, or in the background, is this debate about, is a strong dollar better or worse for the U.S.? I guess I would ask you, what does strong dollar mean? What is the magic level for where the dollar should be, that it sort of balances the pros and the cons?
So you know that at some point, the dollar can be too strong, because you start getting the implication. First, it erodes domestic competitiveness. And because of that, it becomes a political issue. Second, strong dollars tend to break things elsewhere, particularly in emerging markets, who have borrowed in dollars but generate income in local currency. So they have what's called the original sin. And the stronger the dollar gets, the more they have to generate and the harder they find it to generate. And the list goes on. So what we'd like to have is a stable dollar, but getting there means that other countries have to get their act together. If Europe continues to lag, if China continues to lag, then the pressure will be on the dollar to get stronger. So ultimately, the key issue is going to be for China and Europe to do the sorts of reforms that they need in order to grow at a faster rate, and then take off the pressure, which is pushing the dollar stronger.
Mohammed, how do you see market sentiment evolving then, given the risk and maybe the likelihood then of that stronger dollar?
It's ultimately going to be a race between the realities of what President Trump inherits and the extent to which certain policies could make things more complicated. For example, tariffs will push the dollar stronger. Against, on the other side, something that the markets have embraced for good reason, which is his deregulation and liberalization approach. So it's going to be a race to see which of the two sides. The market right now are betting on the deregulation and liberalization horse. They think that this horse will outpace the others, and we will see how that plays out.
And Mohammed, finally, just quickly, given all that we've been talking about, on balance, is this presidency of Donald Trump a greater risk or benefit to the market and to the economy?
It is seen as a greater benefit because it is seen as unleashing business and unleashing U.S. business. So I buy that. I understand why the markets are so enthusiastic, but we shouldn't underestimate that he inherits some pretty difficult issues. We talked about internal and external diversion. We haven't even talked about geopolitics and the extent to which that really hasn't impacted markets, hasn't impacted the economy because of the strength of the U.S. economy. But geopolitics are out there. So he inherits challenges, but the market clearly is betting on him unleashing U.S. business in a way that not only will secure a better outcome for the U.S., but will attract capital and have sort of a leverage effect in terms of benefits.
Mohammed, thanks so much for taking the time here with us before the opening bell this morning. We really appreciate it. And thank you, Julie Hyman, host of Market Domination, for joining us this morning as well. Thanks. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we have a slew of earnings out this morning. Oh, yeah, those still happen. And Netflix coming out after the bell. We'll break down those trending tickers. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, 3M reporting better than expected fourth quarter results boosted by higher sales of industrial adhesives, tape, and electronics. The manufacturer forecasting growth in sales and profit this year as CEO William Brown continues his turnaround plan for the company. Shares right now moving higher by about 4% here. They did mention Q4 sales of $6 billion. That was up just about 0.1% year over year. And then additionally here, organic growth 2.1% year over year there as well. They did see overall a slight decline in the adjusted EPS from continuing operations, down by about 2% year over year. But shares no doubt moving higher, perhaps some of the categories that they're leaning further into, and the company whose earnings call began at the top of this hour, really pointing to some of the areas of strength in the business right now.
Yeah, certainly. I think when you take a look at Bill Brown's turnaround plan and what he laid out back in July, the stock's reaction since then, if you take a look at a 6-month chart, you'll really see the dramatic rise to the upside, move to the upside that we have seen in shares. It's on your screen right now. You're looking at gains of just about 34, almost 35%. So certainly the market is buying in to what we are hearing from Bill Brown. I think the question is what ultimately this timeline is going to look like. Yes, the company has made progress. It is boosting sales growth. They are looking to develop new products here. They are looking for waste reduction, things that are going to help them with their cost-cutting efforts. And I think just taking a step back and overall, some of the sentiment out there from industrial companies right now is that they're pretty optimistic heading into this Trump administration. I was at the Goldman Sachs Industrials and Materials Conference not too long ago and had a chance to speak with a number of business leaders there within this sector. And they overall were talking about, once again, this theme of deregulation, ultimately what that's going to do here for future growth. Very positive just about the economic boost here and some of the activity that we could see over the next 4 years as a result of that. So again, the sentiment, at least heading into the rest of this year, looking ahead to 2025 for 3M specifically, but then also a bit more broadly speaking for the industry, is that they are relatively optimistic and bullish just about what some of those growth rates could potentially look like. Yeah, they mentioned that they are carrying this momentum forward, to your point, in terms of the sentiment and the outlook here, carrying the momentum forward, confident in the ability to deliver their 2025 guidance. That guidance actually calls for adjusted organic sales growth of 2 to 3%, adjusted total sales growth in the range of 0.5% to 1.5%. And then additionally here, they're looking for EPS for the full year in a range of $7.60 to the top end of $7.90 here. So we'll continue to track shares of 3M throughout today. All right, let's take a look at Netflix. Netflix is set to report fourth quarter results after the close today. Yahoo Finance's Alexandra Canal has been digging into what we could expect here in just a couple of hours. Ali.
Yeah, well, it's expected to once again be a strong quarter for Netflix. This is driven by a few things, but think about all the content that we got during the fourth quarter, right? We had that successful Jake Paul-Mike Tyson fight. We had the return of Squid Game Season 2. We had 2 back-to-back NFL games, so a lot to look forward here in this report. On the revenue side, Bloomberg consensus estimates expect Netflix to deliver revenue of $10.11 billion. Netflix issued its own guidance of around $10.13 billion. Earnings per share expected to come in at $4.18, also slightly lower than Netflix's own guidance of $4.23. And then on the subscriber side, analysts expect around 9.2 million net additions. And remember, this is the last quarter that we're going to be receiving that subscriber number from Netflix. So analysts are going to have to look at some other metrics here. But if we go back to the sports conversation, I mean, the Jake Paul-Mike Tyson match, that attracted over 108 million global viewers. The NFL games averaged around 30 million viewers. So sports is clearly the future for Netflix. There are rumors that they could be potentially bidding for the UFC after they acquired WWE. So something to continue to watch. Also, what to watch in this quarter specifically is potential price hikes. It's been 3 years since Netflix raised the price of its $15.49 a month standard plan. So that's something that analysts are looking ahead to, especially since Netflix had increased prices overseas. So something to watch there. And then the valuation story. That's something that we've continued to keep track of as the stock is up about 80% on the year over year period. We do have 2025 revenue expected to decelerate compared to 2024. Netflix anticipates revenue growth between 11 to 13%, a slowdown from last year's 15%. But potentially, if we see price hikes, that could offset some of that slowdown.
Yeah, using the WWE relationship and getting that off the ground to really make sure that they can further the conversation with TKO that owns UFC in order to make sure that they do have a leg in and a way up to making sure that they can get some of those broadcasts as well and those licenses here. But what type of retention? Because sure, there's the attraction, the net new subscribers that you see on the announcement of some of these big fights or the big sporting events, but then the larger retention run rate is going to be, I think, key for a lot of analysts.
And that's exactly why Netflix said they're getting rid of those subscriber numbers, because that's not really the focus at this point. To your point, they want to focus on engagement, keeping those customers on the platform for a longer period of time. And now they have a lot more offerings for consumers when you think about the ad-supported tier. Right now, that's super cheap, one of the cheapest on the market, $6.99 a month. So that's something, again, that I think there's wiggle room there for them to raise prices and hopefully increase that engagement.
Not mine. Keep my prices the same.
I know. I do the ad tier, and I love the cheap price point.
Yeah?
So.
Okay.
You know what? I just downgraded to the ad tier, and I should.
Well, it might be going up again, Shauna. So here we go.
At least, hopefully, it won't be back to the 15 or 16
exactly
that I was paying.
Is that what I'm paying?
No. Well, that's what
That's a
I
standard
was
plan.
paying. Now I think the ad tier is right around like $7 or $8.
$7,
right?
yeah.
$7 there.
Just share your password with me.
Even that each time. All right, Allie, thanks so much. Coming up, the opening bell on Wall Street will bring you the latest market action. Again, we've got the opening bell in just a few minutes.
There you're taking a live look at the opening bell at the New York Stock Exchange venue, ringing the opening bell there. And at the Nasdaq, you've got EXP ringing the opening bell. They've got some funfetti in the air, clapping and cheering everywhere. Hey, let's take a look at the Dow Jones Industrial Average. That's up by about 0.4% to begin this, the first day of trading under the Trump administration 2.0. As we're taking a look at the Dow, that opens up higher by about 0.4%. Nasdaq Composite, you're seeing that calibrating here on our screens. The S&P 500, that's up by about 0.5%. And there they go. The Nasdaq Composite is calibrated. That's up 0.5% to begin today's trading activity. activity. Let's take a look at some heat maps for you here. We heard you love maps, so we put some red and green colors on them. We're taking a look right now at industrials leading the pack, and then energy actually pulling up the caboose. That's down right now by about 0.1% to begin today's trading activity. Sea of green, though, largely here as we are taking a look at what looks to be 10 movers in the upside here to the upside of the 11 S&P 500 sectors. I want to take a quick look at the Nasdaq 100 to begin today's trading activity. You had some big tech CEOs that were at the inauguration yesterday, present at a few of the different events here, and there you're taking a look at some of the movement for their companies as well. Tim Cook, he was seen present. Shares of Apple right now down 2.7% as of right now. You've also got, of course, Sundar Pichai that was there as well. Google opens up the day. Alphabet up by about 2.4%. Amazon, Jeff Bezos, he was there too, 1.4%. Of course, he's no longer the CEO of Amazon, but hey, still founder. All right, let's get on over to Yahoo Finance's Jared Blickery for a look at what is moving. Hey, Jared.
Hi there. Let's go to small caps real quick because those are looking at a sixth day of gains here. And if we show the 1-year chart, you can see still kind of caught in this range area that it's been caught in several months prior, going back to last year. We'll see if we can break through. Also want to talk about the US dollar and also the 10-year. And let's just go to the 10-year quickly. I'll put a 3-month chart on there. And you can see that has fallen to a 2-week low. So that's important. US dollar had its biggest drop since November of 2023 yesterday. It has climbed back a little bit down to the support level, but critically, it is not thrusting through that 110 level that was causing a lot of pain for traders. So all having been said there, it looks like the US dollar index is not the wrecking ball that we thought it was a week or two ago. Want to point out that industrials and also materials and financials, those are up 6 days straight now. We'll see if that continues into the close. Energy, which had been up for 7 straight days, looks like it's going to snap that streak, but we do have quite a bit of the trading left in the day. Also want to point out that crude oil has been up 4 days, and that kind of speaks as to some strength that we've seen in energy, but not today. And let's see if we can find that CL equals F. If I don't find it here, and I do apologize for that, there we go, down 2.3%. So if we take a look at the 1-year chart, we can see it had recently broken to a higher level we hadn't seen in some time, and now it's back to support. Got to bounce from here if we're going to keep that crude oil rally alive. Shauna.
All right, Jared, thanks so much. So now for today's strategy session, we're digging into President Trump's initial actions in office and the sectors that will be affected by his subsequent policies, starting off with tariffs. The president warning of 25% tariffs on Mexico and Canada as soon as February 1st. So what does this all mean for the markets? We want to bring in Lee Munson. He's the president and chief investment officer of Portfolio Wealth Advisors. Well, Lee, we certainly have seen this reaction play out in the markets. We saw it in futures yesterday. We saw it in the move in the dollar yesterday and here this morning. I'm curious just about this whipsaw action that we certainly have seen, the increasing volatility. Is that something that investors are going to have to get a bit used to here in the second term?
I think you're going to have to. I mean, first, we in the inauguration speech was really a State of the Union. We didn't hear anything about tariffs, but then later in the day, they let slip out in a presser that they're going to do this 25% tariff in Canada and Mexico. I don't really think he's going to do it. I think that's a bluff. I mean, put it this way. They don't have a plan on China right now. That isn't the most obvious thing. So I think the idea that we're going to slap on these big, horrible tariffs that are going to push inflation higher, I don't think I buy it. And look at the 30-year Treasury today. If everybody bought it, that 30-year Treasury would be back up to 5%.
Okay, so it sounded like, and just to complete the thought there a moment ago, it sounds like you don't expect them to go into effect.
No, I think that we're going to get, there's going to be something that's going to happen. I think he's just a bully that's using this. That's his tactic, right? We know how he operates. He's going to use this to try to get what he wants. And by putting that timeline, saying February 1st, 25%, how is he going to talk to the automakers of America? How is he going to talk to, what's this going to do to the price of energy? Energy's down today. That doesn't sound like people think that Canada is going to have huge tariffs. What about all the aluminum production that we get from Canada, from that hydroelectric power? So I think we have to, this guy says a lot of stuff, and he's, he negotiates very hard and negotiates from a way that, we haven't seen in the last 4 years. And I think investors are going to have to get used to that. But I still think when you look at prices, the prices today reflect a little bit more reality. And that means that I don't think we're going to have runaway inflation. The other thing he didn't say yesterday is he was not real specific about all these tax cuts that he's going to do in terms of, yeah, we know what he wants, but he wasn't reiterating all of them from top to bottom.
Well, yeah, using 1.0 as a guide, details typically run a little bit scarce early on, as we know. Lee, if it is indeed a bluff, what is your top trade idea? Because that would actually remove a lot of uncertainty then in the form of if there was a tit for tat play out.
Yeah, I think so. You know, the places that I feel more comfortable with, obviously everybody on the street has this idea about how the financials, the banks are going to do well. I don't disagree with that. I think the financials are going to do great this year. I just think a lot of the gains have already sort of occurred from that Trump bump. I think, what are you going to do? You're going to get the capital requirements to go down a little bit. I don't think that's going to be a mover and shaker. So while I think that's going to be a good theme, I think I can make more money other places. I still love defense, this idea that we're going to get out of wars. I mean, he's talking about, taking over the Panama Canal. The way you stop wars is peace through strength. We have an old saying out here in Albuquerque called always never. I think you're going to have a golden age of nuclear deterrence start coming back online in this country that we need to rebuild. I think you're going to see hypersonic cruise missile technology. Plus, he wants to go to the moon. I would be long those defense aerospace names. I love TransDigm. Last year, Buffett's team over at Berkshire bought a company in the space called HICO. So I think that's a place you could go. And then obviously cybersecurity. We're not going to put any guardrails on AI. He didn't even talk about AI last night. And so I think that's another big thing.
Yeah, Lee, what do you think about the fact that we didn't really hear a bit more about AI? Yes, he did repeal Biden's executive order when it comes to AI. We're seeing a bit of a bounce here in some of those chip makers. But ultimately, how do you see it affecting investor sentiment and maybe some of the opportunities within that sector?
Well, look at the people behind him at the inauguration. They weren't people who are running the government. They're people who are running AI. I think it's going to be a free-for-all. I don't think there's going to be any guardrails put on that. But here's what investors really want to see. We want to see that use. We want to see something that you can bolt on an app, on something that's going to take an old railroad company or a steel company or like a bank where you can just bolt it on and increase productivity, where you can measure productivity. Right now, we don't really have that yet. So any application, any company out there that can go to a firm and say, hey, if you bolt this onto your system, we can prove to you that your workers are getting more productive. And that's going to be something that people want to hear. And also, when you're talking about these deportations, listen, GDP is equals to hours worked times productivity. AI is the only thing that's going to jack up productivity right now. So why would Trump be putting guardrails on it right now?
Yeah, looked like about a $1 trillion total net worth combined behind him in that photo a moment ago that we were showing. Lee, thanks so much for taking the time.
Thank you.
Coming up, Bank of America CEO Brian Moynihan says he's not ruling out a Fed rate hike this year. That and much more from Davos.
Yahoo Finance is on the ground at the World Economic Forum in Davos, Switzerland, and lots of focus on the incoming Trump administration, what that may mean for markets, what they might mean for the world's biggest banks. Speaking of banks, we're here with Bank of America Chair and CEO Brian Moynihan. Brian, good to see you.
Good to be here again.
No jacket as always.
No jacket. It's nighttime. It's a little cooler out here tonight, but it's fine.
Fair enough. So President Trump, newly inaugurated, promising this will be a new era of prosperity for the country. Are you on board with that?
Well, I think in the end of the day, if you speak from the business community, which largely, we have thousands and thousands and millions of business clients, I think they believe there's an opportunity here that the tax regime will stay in place, which is an advantage in the United States, that the regulatory environment will move back to the center, and that the opportunities off of that, because the President of the United States, are high. And I think that that's given enthusiasm. And that to me is, from the business side, that's the major part of this message, which is less regulation, tax regime stable, investments in America, and for mid-sized companies and small companies in America, that's great news.
I remember you telling me at our Invest conference in November, you were concerned about deficits and how they've ballooned. Can the administration push through tax cuts and what it wants to do, given where deficits are?
I think the tax cuts will be hard because where do you find the revenue to cover them? But maintaining tax rates, it's going to take some spending reduction. It's going to take some views on how they spend money, where they spend money. It's going to take some, hopefully some more growth to grow your way out of a little bit. It's going to take, and the predicted growth is higher, and it's going to take other activities. But backing up, I think the incoming Treasury Secretary in his hearing made it clear. We've got to get this debt balanced out. It doesn't have to go down. It just has to flatten out against the growth of the economy. And I think having a strong economy is the backbone of that. And then getting people to invest and create even more jobs and more growth is the backbone of that. But we've got to be careful. We've got to get this a little bit more rational. And that's, to me, that's one of the biggest issues America faces alone. There's worldwide issues, wars, this, that. But the one America faces alone is to get the debt back in line just a bit. And that's going to take some disciplined spending.
You think that's what we're seeing? I look at what's happening in the with the 10-year yield, close to 5%. A competitor bank, Nomura, calling for 6%. Do you think that's the early warning signal that these deficits have to be brought under control?
Well, I think that's where, Brian, you have to get away from the trading question to the long-term question. We were at this level, 6 months ago, whatever it was, and it's back to this level. And when the 3%, a 4.5% Fed funds rate, you expect the 10-year to be higher because that'd be the natural shape of the curve. If you go back and look pre-financial crisis, 70-odd% of the days, the 10-year traded between 4 and 5 or something like that. This is more of a normal rate environment, which frankly, with all the work that's gone on and all the post-financial crisis, to have a great financial services system, to have a real interest rate environment, to have inflation be higher and bringing it down, as opposed to for 15 years we couldn't get inflation up. It's actually a good place to be, to have a little more robust economy, going back to the debt question, because the inflation makes the debt smaller if you don't issue a lot more of it. The second thing is it's more normal. And so I think we got to be careful about overreading it. So I think, yes, there's momentary trading days where people, oh my gosh, they're going to be issuing a lot of debt, let me back off or let me come in. But at the end of the day, I think it'll fundamentally settle in a range. Our team has a predicted in this 4.5% or so plus or minus range, and has the Fed funds ultimately getting down to basically 50 basis points lower it is today at most, and that's kind of a real rate structure.
Hang with me on this. I'm going to try to tie some dots together. Should we get tariffs? That might lead to inflation. Do you think the Fed's next move is a rate hike? There's been some chatter about that on the ground here in the early going.
Well, I think it's few hours old, so nobody really knows what the potential tariff question is. Our team, our research team, and Candace Browning-Platt and the team looked at the discussion around tariffs and came to the conclusion that 10-15% doesn't think has a big impact the economy or inflation. You start rising above that, it gets a little more interesting, and then it becomes very specific as to where. And so most of that will be passed through, and the customers will absorb it, and there'll be more wage demands, and it'll kind of work. And so it could be inflationary. But I think in the nominal levels they're talking about widespread, less possibility of that than if it were higher across everything. If it's focused, that again doesn't have as broad effect. But I think this is the question that the Fed has to think about: is they've got a new administration with a new set of fiscal policies, and the monetary policy has to respond to that. We are not a central bank-led economy. We're actually a private sector-led economy, of which the government supports, of which the central bank responds to, and they have to think of what stimulus they're going to, what data they're going to respond to. And you're hearing that chatter go back and forth. I think on the other side, consumers are spending at a level in our business which is consistent with a 2% inflation, 2% growth economy. So we've got to be a little careful that we don't dispirit the consumer with high rates, especially on the front end, especially the small business and mid-sized companies, because they pay the higher rates. Large companies go to the market, get out the curve, and frankly, other than mortgages, the impact of the rates on the general consumer borrowing is relatively minor. It's cars and mortgage, the two places you feel it, and half the mortgage, and most of the mortgage holders are locked in at a far rate lower, and that if they have to move or something, that's a different question.
Bank stocks have been really on a tear since the election. We leave one of the largest banks in the world. What could this administration do in terms of regulation to justify the moves we've seen in financials? What do you want to see from the Trump administration?
Well, we in the industry have been clear with the Biden administration, the old Trump administration, and the Biden administration. We want a highly strong capitalized, strong liquid set of institutions in this country, because it is one of the reasons why America has success is it has a great financial services sector, a great capital markets, a great banking sector, serving people well, growing, innovation, the whole 9 yards. So we believe in that. But what happened over the last period of time here is the creep up of all the different factors. And so if you point to any one, you say, well, that's not that much. But when you add them all together, simply put, we have about 25 or 30% more capital to get the same capital ratio 5 years later. Our risk hasn't changed much. Matter of fact, our risk has probably come down. And you're saying, how could that be possible? It's all in the underlying counting and rules. And so people are saying, can we slow that down and put it back in the center? We are the most competitive in the United States of all the financial services industries in the world. So the idea of it making us competitive isn't the problem. The idea of it keeping us competitive, we've got to be careful of. But why shouldn't we be the best? Why shouldn't we lead? Why shouldn't we help drive the world's growth through the major institutions in the United States? Because that's good for the country. It's an exported industry of high order. So I think what we want to see is capital, a little more rational, and you heard the dialogue on the stress tests and things like that.
So that's like the Basel III.
Basel III and stress tests, the two go side by side, and a bunch of other rules. And then secondly, you want to take a look at some of the liquidity and other rules which got stacked up and actually have an adverse effect on carrying capital, which doesn't make a lot of sense because some of the other tedious things that go on banking regulation. And then you want to look at regulation around consumer activities and keep it balanced, because what you don't want is a company to run it one way, then this way and that way. You really want to run it so the consumers can depend on it, we can depend on the consumers, and have a set of rules and laws that are actually implemented by the people the consumers voted for, Congress, and then the agencies react to that instead of people making up law through agency action.
Bank of America Chair and CEO Brian Moynihan, always good to see you. Go back and get a jacket. Let's get you out of here. Come on.
It's warm out tonight. It's 10 degrees above normal.
All right, Brian, always good to see you. Appreciate it.
Good to see you.
All right, thank you.
President Trump threatening 25% tariffs on Mexico and Canada by February 1st. If enacted, it could be problematic for America's car makers who manufacture a significant number of their vehicles from these two nations. Here to discuss, we want to bring in Tom Narayan. He's RBC Capital Markets Global Autos lead equity analyst. Tom, it's great to see you again. Once again, we're talking about tariffs, and I bring this up just in the context of what we heard yesterday, because maybe it's safe to say it's a bit more hawkish than maybe what many have been expecting, at least when it comes to Canada and Mexico off the bat. How was the auto industry responding this morning?
Yeah, I mean, I actually think it was going to be expected, right? We saw the similar type of language the first Trump administration, very hawkish early on, set the stage, art of the deal, whatever you want to call it. One thing that was interesting is it was pushed to February. There was some language earlier on that it would happen first day, that kind of thing. So I think the fact that it's pushed to February gives us some inclination of probably this is a negotiating tactic. The impact on the auto industry, the U.S. auto industry, would be so bad that, this is probably more of negotiating. If you look at the language also of the speeches, et cetera, there were more language around China, H-1B visa, these types of topics, less so on Mexico, I thought, in Canada. And, we've been saying this all along. It didn't get implemented the first go around. We don't think they get implemented this time.
Tom, we heard from President Trump that we are going to be getting back towards what he says is going to be building automobiles in America, again, at a rate that nobody could have dreamt possible just a few years ago. Tesla in 2023 had one of their best production years ever. Ford, they built in 2023 1.8 million vehicles as well, or Tesla built 1.8 million vehicles. Ford also, 1.8 million vehicles. This also is just addressing the supply side. What is the reality of the demand side play out that you're anticipating for people buying the vehicles that are getting produced?
Yeah, exactly. I mean, this the now president ran on a campaign of bringing inflation down. Car purchase is one of the most highest profile purchases the consumer can make. We already are at record high auto pricing. That's starting to slowly come down. And so if this were to happen, it would be, it'd be tremendously inflationary and not something that just is fixed overnight. You can't just shift production to the U.S. Maybe the OEMs could shift some, pickup truck production more to the U.S. But what happens to the supplier base, right? The seating industry is completely in Mexico based. That would take years potentially to shift production to the U.S. and be tremendously costly. And to whose benefit, really? So it isn't like a huge job creator necessarily. It has more of a destructive impact on, in aggregate to the industry and to jobs near term. And to your point, it would be very inflationary. And that's not something that this president has run on in the campaigning for the seat that he has.
Tom, you've been crunching the numbers. What does the exposure look like of the largest automakers and ultimately the impact that this could have if this were to theoretically go into effect?
Yeah, so for the automakers, the D3 are the most impacted. GM has obviously the most exposure. But it's not like Ford and Stellantis are immune, right? They all produce down there. What I would say, though, is while the OEMs definitely have exposure, the supply base is really where the pinch point is. There are suppliers, like I was speaking of earlier, that are completely based on specific components, seating I mentioned in Mexico. If you don't have seats, you can't make the car. Right. So it has a trickle down effect to the rest of the ecosystem, even the automakers. So I would say probably GM is the most exposed. The reality is there are suppliers that are far more exposed. They can't do anything about it. And the overall U.S. auto industry would really be crippled, frankly.
Tom, with Trump back at Pennsylvania Ave 1600, what is your top auto pick now, hearing how these decisions might play out?
Yeah, I don't think my thinking has really changed all that much. We saw what happened in the first go around. I think something very similar, doesn't happen this go around. So it's the same picks. I like GM. I like Ferrari. And I do like Tesla. Those are the three names. I'm still somewhat defensive on the group, but things are actually looking more optimistic. I don't think tariffs happen. U.S. car sales are actually picked up in December. Inventories came down. So as long as the consumer stays healthy, I think autos could actually be an interesting place. These stocks have really suffered, so it could be something to be opportunistic. But currently, those are the three that I like.
Wish we had more time to get into Tesla. Those shares off just about 3% here this morning. Tom, great stuff. Thanks so much.
Sure.
That does it for a morning brief, but join me and my co-host Madison Mills. We've got you for the next hour. Much more analysis coming up on Catalyst.
For investments.
And continuing on Trump's day one agenda, we'll tell you how executive orders on immigration and energy could impact the markets and the economy.
Plus, we'll head overseas to Davos, Switzerland at the World Economic Forum, where our very own Brian Sozzi is interviewing the CEO of Cloudflare. That's later in the hour.
Let's take a look at some of the market headlines to start the hour here, 30 minutes into the U.S. trading day. And if you take a look at the three major averages, we're off to a relatively strong start. You've got the Nasdaq up just at nearly 1.5%. You've got the Dow up just over 300. The S&P also adding on about 0.8%. Flipping over to the bond market, lots of action recently in the yield picture that we are seeing. Look at the 10-year yield pulling back again just a bit, right around the 4.57 level. So well off the highs that we saw not too long ago, but still above 4.5. And finally, taking a look at the dollar, Maddie, this is really where we've seen a lot of the movement over the last 24 hours as President Trump has been inaugurated. You're looking at a bit of a pullback here. We did see some strengthening initially yesterday. And of course, a lot of the reaction, a lot of the movement that we've seen over the last 24 hours has to do with some of the policy initiatives laid out, most specifically what we're learning here about tariffs.
And I know you all spoke with Mohamed El-Erian about this in the previous hour, this idea of whether or not we are going to finally see some of that investment more globally. And he said what he's been saying for years, we're going to continue to have to wait on that, but we still continue to see that valuation concern in the U.S. leading to that constant question, when will we get more investment globally? Having said that, sticking in U.S. equities, it's interesting to see the market kind of repeating itself, seeing a little bit of a relief rally today following the lack of huge news on tariffs, at least in the form of executive orders on Trump's first day in office here. Will we see this movie again that we saw following the election, where we saw that huge rally and then weeks of declines to the downside?
Yeah, it certainly is going to be very interesting to watch. And you take a look at some of the sector action that we are seeing this morning, like you were saying, not a huge surprise just in terms of some of that leadership. Also want to call out some of the Chinese listed U.S. stocks here this morning, also getting a bit of a bump. I think a lot of that has to do with the fact that we didn't get too much when it comes to China and the approach that we could see from the Trump administration. When it comes to tariffs, very much just reading into that we're still in the planning, the early phases of this, and not too much worry, at least for right now.
Yeah, and certainly seeing a lot of the big tech names also catching a bid this morning, following tech CEOs flanking President Trump at the inauguration, seated in front of administration officials. You can see here Meta's Mark Zuckerberg, Google's Sundar Pichai, Amazon's Jeff Bezos, and Tesla's Elon Musk. Joining us now on what the tech-heavy crowd indicates, we've got our very own Yasmin Karam. And Yasmin, Elon Musk sort of started this trend amongst the tech CEOs. It seems like Zuckerberg is sort of following suit. What can you tell us about the domino effect?
Yeah, there's certainly a huge domino effect. Front and center yesterday was Meta's Mark Zuckerberg, who has had quite the roller coaster relationship with the president. Zuckerberg last night co-hosted an inaugural ball for the president, posting this photo of himself with his wife, Priscilla Chan, with the caption, "Optimism and celebrating." It wasn't too long ago that Trump threatened Zuckerberg with jail time if he rigged the election. Remember, Zuckerberg kicked Trump off of Facebook and Instagram 2 years ago in light of the January 6th attacks on the Capitol. Now, fast forward to this month, Zuckerberg has had an about-face, overhauling Meta's policies, adding Dana White to the board. Two sources tell me there's a lot more changes coming to Meta. I've been speaking to Meta insiders who describe Zuckerberg as, quote, a chameleon, who now wants to be seen as somebody who can work with Trump and Republicans. Zuckerberg wants to reportedly play an active role in the president's policymaking when it comes to tech. And ironically, as you mentioned, Maddie, he's basically turning into his rival, Elon Musk. Sources have been describing him as, quote, Little Musk. Remember, the two were about to battle it out in a cage match that never happened, fortunately or unfortunately. But Trump is the president. First and foremost, he was a businessman. I think it's important to remember that his cabinet will be super influential, but more important are the people outside of the government who will have his ear. Zuckerberg, Musk, Pichai, Tim Cook, they will all be on speed dial for the next 4 years.
Seems like it, at least when you take a look at the presence and the influence that they will likely have here over the next 4 years. Yasmin, let's talk about the TikTok update that we did get, the suspension of the ban here, and bring that up in the context of Meta right now. Does that have the potential to maybe complicate some of the relationships that Trump does seem to be forming with these larger tech CEOs?
Yeah, so analysts I spoke to said one of the reasons that Zuckerberg might be playing into President Trump's hand is because Meta will obviously be a huge beneficiary if TikTok is in fact banned. Now, last night, Trump, set an executive order, save TikTok for the foreseeable future. So clearly he is not as loyal as he might have been. But, this is kind of the the power play that we're going to see over the next 4 years. And it'll be very interesting to see how it all plays out. As you know, Biden warned of a tech oligarchy. Clearly, President Trump and these CEOs don't listen.
All right, Yasmin, great stuff. Thanks so much. Let's continue the conversation surrounding President Trump's relationship with big tech. And for that, we want to bring in Bradley Tusk. He's the founder and CEO of Tusk Venture Partners. Bradley, it's great to have you on set here this morning. I'm curious how you're thinking about the presence of big tech at the inauguration yesterday and maybe what that signals about the coming 4 years.
Yeah, I mean, it's certainly a turnaround from what you saw under Biden. And, there are very clear policy needs that a lot of the people who were sitting, on the dais yesterday have. If you take Zuckerberg as just the example, one, in his perfect world, TikTok would go away. That's 170 million customers up for grabs. Two, he, and it's also true for Google, for Amazon, for Apple, for all of them, want the antitrust prosecutions against them to stop. Lena Khan and Biden were very aggressive around that. And then third, there are specific policy things like, for example, Section 230, which is a provision in federal law that protects all the platforms from any liability for the content posted by their users. They want that to stay on the books. AI regulations will start coming. They want that to be favorable to them. Crypto regulation. So, there's a lot at stake for these companies. And I think that in Trump, they have a person that they can at least have a dialogue with. Whereas with Biden was such a creature of the Beltway and of politics and so old, quite frankly. And his team were basically creatures of the Beltway and politics and pretty old also, that I think that they just didn't really even know what to make of that world.
What did the day one agenda and the presence of these tech executives clarify for you that might impact your investing in your position?
Yeah, I mean, I think it's sort of a story of short-term gain, long-term pain, or short-term pain, long-term gain, depending on the category, right? So for example, immigration. A lot of industries in this country do rely on illegal immigration, and if there were mass deportations, which I think logistically is really, really hard to pull off, but if there were, that would be a problem, right? Because a lot of people need those workers. However, what our economy really needs long-term are millions and millions of more legal immigrants who are here filling needs in industries like construction, like nursing, who are paying taxes, because as our population keeps getting older and older and we have to pay more and more for Social Security and Medicare, we've got to repopulate the tax rolls with a lot younger people. I don't think you can ever get to a place to have a true deal on immigration to really increase legal immigration until you deal with the problem of illegal immigration first. So however you feel, either morally or even economically, about some of Trump's orders, to me, if the goal is to ultimately get to the right place long term, that's good for the economy. On the other hand, energy, I think people will cheer the fact that energy production is going to be opened up, and that might have a positive benefit on the markets and the economy short term. But if you look at the cost of the LA fires, that's devastating for the economy and devastating for business. We're looking at, I've seen estimates of over $200 billion in losses. That's because we're not dealing with climate change sufficiently, right? So yes, you can permit more drilling, more coal plants, everything else. And in the short term, it probably will increase the margins and profits of those companies. But you're going to have more LA fires, more droughts, more hurricanes, more tornadoes, more earthquakes, everything else. And ask the insurance industry how they feel about that. Or tariffs will be the third, which is short term, there will be pain. And by the way, pain especially for American consumers, right? If we're looking at a 25% tariff on all goods from Canada and Mexico, whether it's your home heating oil or avocados, everything's 25% more expensive. That's really a problem. On the other hand, if Trump is right that there's an unequal playing field between the U.S. and the other two countries in NAFTA, between the U.S. and China, around NATO, then trying to level that does make sense.
Bradley, let's talk about TikTok and the update that we got last night from President Trump, pushing off the ban just a bit, or pausing the TikTok ban. Questions about the legality of this and how this is going to play out in the coming months. How do you think, what does this tell us just in terms of the implications, maybe more broadly speaking, for big tech and how Trump is then likely to approach some of these issues, especially when it comes to national security over the next 4 years?
Yeah, I mean, I think the thing that Trump was very telling, I saw some article this morning where they said, like, what made you change your position on TikTok? And he said, well, I started using it. Yeah. And at the end of the day, Trump believes in Trump. Right? So there's no underlying ideology that he has fealty to, whether it's conservative, liberal, libertarian, so it doesn't matter, right? He's going to do what's best for him. So when their interests align with his, it's going to work out for them. And when they don't, it won't, right? And so, for example, if you look at TikTok, the investors who are in ByteDance clearly want the law not to take place. If someone like Elon Musk might be a buyer of TikTok, he wants to benefit from that. But if you're Mark Zuckerberg, you don't want the competition and you want TikTok to go away. So, you should never make the mistake of thinking that he likes you, he cares about you, he's loyal to you. He likes, cares about, and is loyal only to himself. And when your interests are aligned with his, that's when you get stuff done.
That seems like an important framework, too, just in terms of Mark Zuckerberg being there and the positive catalyst that a TikTok ban could be for Meta.
Yeah, for sure.
Maybe you're saying investors don't read too much into that because Trump will do what he wants with TikTok.
100% of the time, right? And as soon as someone is not useful for Trump, they will be discarded. There are very few people who made it sort of the first term unscathed. He's not a different person, right? Maybe getting shot changed him a little bit, but at the end of the day, he's Trump. And there are things about him that obviously appeal to the American people. A majority of people selected him in this election. But at the same time, if you don't go in with your eyes open, you're going to get burned.
And how long do you think Elon Musk lasts then under that?
I mean, it really depends in some ways. The most important thing Elon can do is show great deference to the president and tamp down any stories that he's co-equal or he's really the president or anything like that. It's just Trump's ego and insecurity that'll get in the way. So for as long as Trump feels like Elon is deferential to him, that can probably keep going. The minute that Trump starts hearing that it's really President Musk and not President Trump, that's when he's got a problem.
How successful do you think Musk is going to be, to that note, in the Trump administration? And I guess just in terms of being effective.
Yeah.
How realistic are some of these expectations?
There's two things, right? So first of all, keep in mind, Musk, kind of like Trump, especially with this new crypto, meme coin that Trump has, in many ways benefits economically from sort of perception and even pixie dust, right? The share price of Tesla makes no sense whatsoever when you look at economic metrics, but Musk has this sort of public aura, and Tesla's share price has gone up exponentially since Trump won. So Musk makes more money through image and branding than he does through making cars or satellites or anything else. So he knows that being in the West Wing is the best way for him to maximize his own personal wealth and earnings. When it comes to Doge specifically, look, I think he's going to find that government is a lot harder to get things done in than he realizes. A lot of stuff makes sense on paper, looks easy on paper, and then you start applying it to the real world, and they don't really care. But I do think that there's some real opportunity here. So for example, I spent the first 15 years of my career working in government, and things like procurement, rulemaking, licensure, permitting, there's so many functions that are performed so inefficiently, so expensively, that you could use AI and new technology for instead. That would be far more honest and far more cost effective. And so, if Elon and Doge could even start implementing some of that, that would make a big difference.
All right, Bradley Tusk, we have to leave it there. Thanks so much for taking the time.
Thank you for having me.
Join us here at the desk. Coming up, a look at some of the top trending tickers here on Yahoo Finance this morning. We've got the biggest stock movers when we come back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session at Yahoo Finance's trending tickers page. First up, let's take a look at Walgreens. Walgreens shares under pressure here this morning, now off just over 11%. The move to the downside coming after the Department of Justice sued the company for allegedly dispensing millions of unlawful prescriptions specifically related to opioids. Now, this could increase the likelihood of a leverage buy. It actually could increase some of the risks associated with talks of a leverage buyout here by the PE firm Sycamore Partners. So very much putting that into question. That's the real takeaway from Wall Street here this morning. A number of analysts out just talking about the fact that it already pressures the cash flow, as well as reports here that it could go private with Sycamore Partners. So just in terms of, I guess, the uncertainty that this also reintroduces, there was lots of talk, or maybe the thing, not so much talk, but maybe the thinking out there in the industry is whether or not we are past the worst of it when it comes to some of these opioid suits, when it comes to some of these issues that has been plaguing not only Walgreens, but some of its peers within the sector. I think this very much shows that these red flags are not yet behind the sector, and very much something that investors need to be paying attention to.
And it's really interesting given just the pressure that we've seen on Walgreens stock and these several kind of factors that are headwinds for the company here. I took a look at the analyst recommendations because I was interested in that JP Morgan call that you're pointing out, Shauna, this idea that maybe this isn't that much of a long-term risk for the company. But having said that, we still have a mixed picture when it comes to these analyst ratings. A little over half the street, 66% of analysts have a hold rating. Only 3 have buys, and then 3 have that rare sell rating on the stock. So that paints a pretty mixed picture, and one that is indicative of the headwinds facing Walgreens that also, to your point, kind of lead to these talks of a potential leveraged buyout with Sycamore and what that will look like. It's also interesting given the share move to the upside that we saw for Walgreens after that news of that potential buyout broke.
Yeah, and JP Morgan within their notes saying, quote, "We believe that the headline risk is a reminder that opioid risks are not fully behind it, making that leveraged buyout, LBO, even more difficult for a buyer there." So again, some of that sentiment shifting a bit on the street.
Yeah, absolutely. All right, well, we're going to look at Apple, the stock under pressure this morning after downgrades from both Jefferies and Loop Capital. Shares down about 3.5% right now. The analysts behind those downgrades citing weak iPhone demand after sales fell 18% in China during the December quarter. That's according to Counterpoint Research. Now, the stock has continued to move to the downside over the last month, now down over 12%. Just this morning, it was down about 8%. So that's indicative of today's moves. And then Jefferies throwing cold water on this idea of AI as a potential catalyst for Apple, with the analysts saying that the AI outlook is subdued. JP Morgan this morning then keeping their overweight rate on the stock, but lowering its price target on Apple. So just a slew of headwinds for this stock today, which is interesting in the context of some of the other big tech names that we're seeing get a lift this morning.
Yeah, certainly. And we've talked about the pressure that has been on Apple now for quite some time. You talk about the underperformance since the start of the year. You take into account the drop that we are seeing today. It's actually fallen more than 15%, I believe, from the peak that we saw going back to December. So again, lots of pressure placed on the stock. A lot of that surrounding the AI and lack of inclusion there, specifically in China, what that is going to do to demand as Apple tries to work here to find a partner there. Loop was out this morning reiterating many of the things that were noted in that previous report from Jefferies, but they also went on to say that they certainly won't be for the next 9 months, given we're on the front end of the 2.5 quarters of materially softening iPhone demand. So they don't see some of those more constructive catalysts really materializing here, at least in the short term, given some of those longer term concerns that have been plaguing Apple. And then, of course, when you talk about Apple, you talk about some of the tariff discussion, largely expected to be excluded from that. But again, you just have to think about what ultimately means for some of the suppliers and the further diversification that we could see from the tech giant, just in terms of where they are sourcing their products.
And we didn't get that clarity yesterday on those Chinese tariffs specifically, which perhaps is also, to your point, adding a little bit of pressure this morning as we continue to wait and see. It is interesting, though. Apple had a tough January in 2024 as well, and then, of course, ended the year up by double digits. So a reminder that we are still in the early phases of 2025 in the trade.
Let's take a look at some of the regional banks, because Schwab this morning is a trending ticker here at Yahoo Finance. That stock rising after beating estimates and reporting record net inflows. Fourth quarter revenue rising by 20%. That put the full year revenue growth just about 4%. You're looking at gains of 6% here in early trading. It certainly has been a mixed picture here for the regional banks so far this earnings season. But again, some of the positive trends that we are seeing within this report, that is what is sticking out to the street here this morning. Jeffrey's out saying that the results actually show, quote, positive trends everywhere and acceleration in organic growth. KBW reiterating its emphasis on meaningful NIM expansion here, net interest margin in 2025. Again, a key catalyst here, not only for Schwab, but obviously a focal point for many of these banks this past earnings season.
It's interesting in the context of this idea that retail is still getting on board with the stock market and kind of jumping in ahead of potential gains to come under Trump 2.0, looking particularly at the beats across the board here. But down the line, you can see this beat in total active brokerage accounts coming in a little bit above estimates, leading to this idea of an increase in those brokerage accounts, getting more users signed up for them, and how that is leading to that broader revenue stream for them. Again, that growth coming in above estimates for the year. And I thought you pointed out the perfect quote here from Jeffrey, saying it points to positive trends everywhere. So not just, in terms of that top line revenue growth, but also across the board, and that acquisition that they're getting from consumers looking for those gains in the market or other things. But, plenty should go around, I guess.
A lot to go around, it sounds like.
The Schwab story. All right, well, coming up, we are breaking down President Trump's first executive actions targeting immigration and the border as well. We'll be right back with that right here on Catalyst.
Bitcoin is the top trender this morning. Bitcoin price is under a bit of pressure now. This comes following President Trump's inaugural address yesterday, where he failed to mention Bitcoin in this speech. Of course, many on the street are waiting for some executive order action when it comes to crypto and the policies there. Yahoo Finance's senior reporter Alexandra Canal is closely tracking this. And I guess the good news is we're off the lows that we saw yesterday.
Yeah, we're off the lows and we're still above $100,000 a coin. Now, there has been quite a bit of bullishness when it comes to Trump and the crypto markets. Bitcoin, one of the biggest beneficiaries since Trump's election, but we have seen this bumpy path over the past few months, and the retreat that we're seeing today comes as investors had been hoping for a crypto push in that first wave of executive orders. That didn't happen. You also had the Trump and Melania meme coins that debuted over the weekend, generating significant buzz, billions of dollars worth of value. Since then, it seems like analysts and crypto watchers have been split on how these meme coins could potentially impact the entire industry. On the one hand, it fuels this crypto optimism that we've seen throughout Trump's campaign, that regulatory environment will continue to remain positive. But there's also the risk of these types of coins could undermine the overall credibility of crypto. That being said, though, industry leaders seem to believe that executive orders are coming. But this does speak to the volatility that Trump can often create when his actions don't immediately line up with his rhetoric. So it's going to take some tangible actions, some clear regulations to boost Bitcoin and other cryptos over the long term. So something that investors are clearly keeping a keen eye on.
And it's not the only currency people are keeping an eye on this morning. Of course, the dollar is still under pressure following that inaugural address. What can you tell us about what that indicates about market sentiment?
Yeah, so the U.S. dollar is greatly tied to Trump's tariff policy, and we did not get that broad-based universal tariff hike on day one. That led to a pullback in the dollar from a nearly 2-year high. Trump did say that he's considering a 25% tariff on both Mexico and China beginning February 1st. So tariffs still expected to come, just not at the pace previously anticipated. And again, it's that weighing of Trump's actions with his words. Morgan Stanley pointed to this in a note out this morning, writing that vigilance is warranted as the U.S. policy path could evolve quickly. Now, the reason a strong dollar can be concerning is that it weighs on earnings growth for companies that do business overseas. That often has a ripple effect into the broader stock market. So something to look out for on these calls this earnings season, especially as we're really in the thick of it right now. And it's something a lot of executives are keeping an eye on.
And Ali, you're also closely watching DJT.
Yes.
It's been a beat
Always
of yours
DJT.
over the last several months. Certainly some volatility there with that stock as President Trump takes the White House. What can we expect there, just in terms of how this is going to play out?
Yeah, this is a big TBD factor for me. DJT, it's the parent company of Trump's Truth Social app, and the president has communicated a lot of his plans, his thoughts, even his grievances through this app. So this is likely to be his main form of communication. He has been reinstated on X, and to that point, there have been rumors that maybe X could acquire Truth Social, given Trump's close relationship with Elon Musk. But this is a company that is completely lacking in fundamentals. And now that he's in office, the future is a bit unclear. The stock had previously been viewed as this parameter of Trump's election odds. And currently the performance, it has been pretty steady. It's still trading around the levels that we saw on election day. And I think this speaks to the memification of Trump and his name, whether you think of a stock like DJT or even the meme coins that we were just discussing. But yes, DJT is the big unknown out there, especially when it comes to this stock price. But again, we're still right around those levels that we saw when Trump beat Kamala Harris.
We are. It's going to be fascinating to see how this stock continues to move throughout the presidency. Ali, thank you so much for joining us. Appreciate it. We're going to continue to monitor President Trump's day one agenda and the impact of that agenda. The president promised immediate action on immigration during his inaugural address.
I will declare a national emergency at our southern border. We will reinstate my Remain in Mexico policy. I will end the practice of catch and release. And I will send troops to the southern border to repel the disastrous invasion of our country.
And following that address, Trump signs executive orders enacting those policies. Trump designated cartels as terrorist organizations and revoked birthright citizenship to the children of undocumented immigrants. Joining us now to discuss some of that policy and how it could impact the economy, we've got Wendy Edelberg, the Hamilton Project Director and Brookings Institution Senior Fellow. Wendy, great to have you. I just mentioned one of those day one policies, birthright citizenship, which is protected under the Constitution. How are you thinking about the tangible impact, the real world impact and likelihood of these policies coming to fruition?
Well, some of them, like the one you just mentioned, are clearly going to be adjudicated in the courts. And so it's unlikely that they will be implemented exactly as Trump wishes. But largely speaking, he's doing what he promised he would do. He is taking steps to harden the border. He is taking steps to deport hundreds of thousands of people from the interior of the country. He talks about wanting to deport millions of people, but just logistically, he's going to be constrained on that front. So in terms of hardening the border and promising deportations, this is what I expected to see from Trump on day one.
Wendy, what does the GDP loss then potentially look like from these mass deportations?
So colleagues and I estimated the GDP effects through two channels. One, what would happen to the reduction in labor supply, just from less immigration, but also what would happen from less consumer spending. Immigrants spend money in our country. And if you add up both of those effects and you think about, a realistic but dire scenario for immigration in 2025, that reduces GDP growth by almost 0.5 percentage point.
I also want to get your reaction, Wendy, to something President Trump said about legal immigration specifically. Take a listen.
I'm fine with legal immigration. I like it. We need people, and I'm absolutely fine with it. We want to have it. We need it because we're going to have a lot of companies coming in to avoid tariffs. We have to have legal immigration.
So, Wendy, if you take that at its word, there's an idea there from Trump that legal immigration will be a backfill to any jobs lost due to deportations, for example. And we spoke with a guest earlier on our show who said that could be good for U.S. economic growth. How are you thinking about that comment from Trump?
I think what's more informative is to look at what Trump did in his first administration. And what he did there is he actually reduced pathways, made narrowed pathways for legal immigration. So he may say that he's for legal immigration, but that's not what he did in his first 4 years in office. So and more so, I think he is talking about making the climate incredibly inhospitable to immigrants in this country. And I think that's also going to put a damper on anyone wanting to come to this country who's got great skills and might be able to work somewhere else instead.
Wendy, how's that going to alter some of the demographic composition that we do see right now within the workforce and the risk there?
This is going to be felt differently across different geographies. So if you look at certain states that have relatively high concentration of immigrant populations, they're going to see very large changes potentially. Texas, Florida, California, New Jersey. These are some areas that are probably going to see relatively large reductions in labor supply, particularly in service sector industries. And then even going more concentrated, there are going to be certain geographies that have probably seen a nice bump in economic growth over the past few years because of increases in immigration. And as a result, restaurants has been expanding. Hair salons have been popping up to serve this population. And those very concentrated geographies are going to see a very stark decline in economic activity.
Can you help our audience link that to the day in and day out prices they might experience, especially given the focus on inflation that in some ways led to this election result?
It's going to be different by different products. So immigrants have a relatively large footprint in the agricultural industry, for example. So I would absolutely expect a reduction in immigration to result in higher prices of agricultural goods, of the kind of food that you buy at the grocery store. But on the flip side, I can imagine there being reduction in prices where immigrants are demanding fewer goods and services. So immigrants have to have a place to live. And fewer immigrants in this country is going to mean less demand for places to live. That could put downward pressure on rent prices. But then you have to think we're also reducing the labor supply of people who can construct those homes. So it's going to differ city by city and even block by block.
Wendy, as we wrap this up, I'm curious just in terms of your takeaways from day one of the Trump administration, this blueprint maybe that we do have of his approach to immigration, both legal and illegal. immigration. What's the big takeaway for investors then at this point of the one thing that they need to keep in mind as we do work through so much of this uncertainty?
I think I think there's a huge amount of uncertainty for how people are going to react to the images that we no doubt see. For example, I found it incredibly heart-wrenching to see people who had been waiting 6 months for an appointment to apply for asylum, a completely normal and usual thing for someone to be able to do in wanting to come into the United States, and seeing that appointment canceled. To me, that was a heart-wrenching image. We are going to see more and more heart-wrenching images. I don't know how consumer sentiment then evolves as those images get displayed across our media. And that could affect consumer spending. It could affect how we feel about, supporting these policies. Some of these policies might get rolled back. I think we're in for a very bumpy ride.
All right, Wendy, thanks so much for taking the time to join us. We really appreciate your insight.
Yeah, thank you.
Coming up, Cloudflare's CEO Matthew Prince joins the show live from Davos, Switzerland. Got that conversation for you coming up next.
All right, welcome to Yahoo Finance's coverage here at the World Economic Forum in Davos, Switzerland. We're going to focus on some cybersecurity right now. Cloudflare co-founder and CEO Matthew Prince. Good to see you, Matthew. Nice.
Thanks for having me.
Yeah, it's only been a year, right?
We meet every year this same spot.
You're the first cybersecurity executive I have talked to here so far at the forum. What does this new administration mean to your industry specifically?
No, I don't think it changes a lot for our administration. The Trump campaign was a customer, the Biden campaign was a customer. We provide cybersecurity services to basically anyone who's there. And I think one of the things is uniting any administration is they want to make sure that our secrets are safe in the nation. And that is been a priority for the Biden administration, as I think it's a priority for the Trump administration. So I think it's actually one of the areas that I don't see a lot of change.
In his prior term, didn't President Trump sign favorable cybersecurity law into effect?
Yeah, I think that's actually been true going back even to the Obama administration. We've just seen over and over again presidents prioritize that the nation's security is paramount. And a big part of that today is cybersecurity. And we're proud of the fact that in the election in last year, more than half of U.S. states, almost all the battleground states, were actually using Cloudflare technology that we provide for free through the Athenian project to make sure that the election was secure and reliable. And one of the things I'm proud of is the fact that cybersecurity wasn't a part of the story in the 2024 election. And I think it's again, that we are getting in front of the bad guys and we're actually protecting the nation.
If you were to meet with President Trump today, what would you tell him in terms of U.S. infrastructure? What needs to be reinvested in?
Yeah, I mean, I think that across the board, there are a lot of industries where they might not have the technical sophistication or wherewithal to stay in front of that. Hospital systems, we've seen the problems with that as they've been targeted. Education, especially primary school education, doesn't always have those resources. And so that's why with the Biden administration, we work very closely in order to provide those services at no cost to those types of institutions. And I think that's the same thing that I would say to the Trump administration. Lean on private industry, ask for our help, and we are happy to help those organizations, those institutions that are in need.
Are we X number of years behind in terms of cybersecurity?
I think it depends. Different industries are at different places. You see industries that have really focused on this. The tech industry has, I think, actually gotten ahead of a lot of these things. But legacy industries, sometimes as they've pieced together various bits, if they weren't born on the web, if they weren't born on the internet, they're still trying to catch up. And so I think it's a tale of multiple different stages that different companies are at. But over the next little bit, again, we want to make sure that whoever you are, wherever you are, you can be secure online.
I was moderating a panel earlier on today, and we were talking about China and how fast they're moving in terms of AI. What does their speed of AI rollout mean to the U.S. national security?
I think in some ways they're moving quickly around AI. But in other ways, they're actually behind where I would have predicted they would be. They had all the data from what they were hoovering up about their populace. They had all of the investment in the technologies that were there. What I think is actually really interesting about the China story is what's held them back is that there's an incredible fear of what these AI systems, because they are unpredictable, could do. If you imagine if Google releases a chatbot tomorrow and someone goes on, if you go on and trick it into sounding like a Nazi, that's going to be really embarrassing to Google, but nobody disappears, nobody goes to jail. On the other hand, if Baidu releases a chatbot and you go on to trick it to pretend to be a student protester in Tiananmen Square in 1989, someone actually disappears, someone goes to jail for that happening. And so I think the fact that they've actually regulated the outputs in an unpredictable system has actually held China back and will continue to hold China back, and actually gives the United States a huge advantage in this space.
Is TikTok a national security risk?
Boy, that's above my pay grade. I've actually never used TikTok, so I'm not totally sure. But I do think that we need to be focused on, what is it that we're giving information up to, and where is that information going to? Where is it flowing? And so I think it's something where a lot of people who've had a lot of briefings and intelligence that I haven't have said there's a real risk here and there's a real problem here. But again, I think it's above my pay grade.
Last year at Davos, you reminded me things were gloomy-ish a little. Yeah. What are you hopeful for from this administration this year? What could they do over the next 4 quarters? I'm always thinking quarters. What could they do over the next 4 quarters to unleash your earnings and maybe go from 10% earnings growth to 25% earnings growth? Yeah,
I think that first of all, the mood at Davos this year does feel more optimistic, which I think, especially because we're in Europe and there is sort of a sentiment that Europe is nervous about a Trump administration, surprised me a little bit. The last 2 years, I think, felt a little bit more pessimistic than this year does. And that, I don't know if that's a positive indicator or a negative indicator, but it's something that's there. I think the Trump administration really focusing on making sure the industries that need protection know that they have resources from the private sector to do that, unleashing the private sector investment in those critical technologies like, the best inference chips, the best silicon that can be out there. All of those things will help Cloudflare in order to be able to protect the nation, protect our businesses, and grow earnings.
Matthew, you're a veteran of the tech industry. You've been around for a bit. We still look great. Of course. But what do you think? You know everybody too. What do you think about tech warming up to the Trump administration? They had front row seats, Matthew, right at the inauguration. in front of some potential cabinet members. Like, what do you think about that?
Well, you know, I can't speak for anyone who was there. I wasn't there. But I do think that in a lot of these cases, these are companies that had something that they had to fix. They had problems and potential risk that was out there. And I think they were kind of coming and saying, listen, we're willing to talk to you. We're willing to engage. And at some level, you know, the tech industry is very much like one of the U.S. battleships. Like, it is an incredibly powerful force for the United States around the rest of the world. And so I think for a while, kind of the war on tech has almost been feeling like we're shooting ourselves in the foot as a nation. We're taking one of our most powerful resources and actually hobbling it. I think if we actually start investing in tech, and not just the big companies, but startups, little tech, all of the different organizations that are out there, that's a huge advantage that the U.S. has. It's sort of the Levi's of, you know, the 2020s, where we can actually spread sort of the American way of life, the American values through the rest of the world, through our tech companies.
Lastly, do you feel a need to meet with this administration? You're okay being at an event like this, doing business and doing it from afar. Do you feel the need to get really close to them?
Yeah, we started under the Obama administration. We had a great relationship with them. First Trump administration, we had a great relationship. Biden administration, we had a great relationship. I imagine we will continue to have a great relationship with the Trump administration. And if they ask us to help with cybersecurity problems, we're ready to serve.
All right, always good to see you. Matthew Prince, Cloudflare, co-founder and CEO. Enjoy the rest of Davos. We appreciate it.
Thank you so much.
All right, much more coverage of the World Economic Forum from Davos, Switzerland on Yahoo Finance, as well as more coverage of all things Trump administration after the president's inauguration. Do stick around.
Crisis was caused by massive overspending and escalating energy prices, and that is why today I will also declare a national energy emergency. We will drill, baby, drill.
Oil prices under a bit of pressure here this morning. You've got crude off at nearly 2%, one day after President Trump declared a national energy emergency and vowed to increase oil and gas production in the U.S. Joining us now, we want to bring in Andy Lipow. He's Lipow Oil Associates President. And Andy, it's great to see you. I want to start with some commentary, actually, that we got earlier this morning. I had a chance to speak with Stifel's Brian Gardner and asked him about President Trump's actions so far within the energy industry. Here's what he told me.
To use his phrase, it's drill, baby, drill. I guess the question is, and this is an open question, is, is it will, baby, will, in terms of are oil companies, energy companies going to do more exploration and production? I think there is a policy in place. It doesn't mean necessarily we're going to see massive new production exploration that are going to lead to a drop in oil prices.
And did you agree? I guess how willing do you see big oil being in terms of expanding their drilling operations?
Well, I do agree with those comments because the big oil producers are looking at the price of crude oil to determine whether they're going to invest or not. Certainly, the Trump administration easing regulations makes more acreage available to these producers, but they still have to decide whether there's going to be a financial reward for investing hundreds of millions of dollars in many cases, especially in the offshore Gulf of Mexico, as well as up in Alaska.
It's interesting given that the U.S. is already at peak oil production, though, and then we continue to hear Trump talking about drill, baby, drill. You can take a look at this chart here and see the U.S. outpacing Russia and Saudi Arabia in terms of oil production, and that's a trend that has been developing over the past decade or so. To what extent does more drilling necessitate decreased oil prices? Is that a given under this administration?
Well, not necessarily on the domestic side. It's expected that oil production will hit another record here in 2025. But I think that the oil market is actually looking at the Trump administration policies overseas. And in other words, what kind of sanctions are going to be continued on Russian oil exports, where India and China have been the biggest customers of Russia. Now they're seeking alternative supplies. What kind of impact are sanctions going to be on Iran? Is there going to be a more robust type of policy to limiting Iranian exports? And we're still receiving some oil, a couple 100,000 barrels a day of Venezuela. And is Trump going to impose sanctions on Venezuela that prevents that oil from reaching the U.S. markets? So all of these policies can impact total world oil supply and consequently the price.
So let's talk a little bit more then about pricing, because here we are today. You have crude off just about 2%. Lots of questions about whether or not we're going to remain range bound. Do the developments of yesterday, and maybe as we learn more from the Trump administration, how do you see that further pressuring prices? To what extent?
Well, I think the drill, baby, drill, as I mentioned, is really going to depend on the producers. But what I am concerned about is the imposition of 25% tariffs on Canada as well as Mexico. As you know, we import about 4 million barrels a day of oil from Canada, both throughout the Midwest, the Rocky Mountains, the East and West Coast. And certainly deliveries to the East and West Coast can be diverted elsewhere. We're also importing about 500,000 barrels a day from Mexico, all by tanker vessel, most of it into the Gulf Coast. That could be diverted elsewhere. And ultimately, the market is concerned that these tariffs will raise the price of gasoline and diesel for the consumer, which is directly opposite what the Trump administration would like.
Which do you think is more likely then? Will prices go up or down for consumers?
I think that it's likely that they will drift on up during the course of this year between the sanctions that the U.S. administration is going to impose on Russia, Iran, and Venezuela, combined with a general slow growth of oil demand around the world. I think we'll see higher prices as we go through this year. But like 2024, it was quite the bumpy ride.
It certainly was. We also saw Trump rolling back some executive orders under the Biden administration, including lifting a freeze on new liquefied natural gas permits. How do you think that impacts the energy market?
I think that's actually very good for U.S. energy production. We just in December brought on a new LNG export facility in Louisiana. There was an expansion down in Corpus Christi. There's a few more LNG facilities that are coming online in the next couple of years. But if we look at the next tranche of LNG investment, which takes years and years and years to come to fruition, Trump's policies will ease that way, and it'll help us get more natural gas out of the ground to overseas markets, especially to Europe, to displace Russian supplies.
All right, Andy Lipow, always great to get your insight here, especially on a day like today. Thanks so much for joining us here this morning.
Thanks for having me.
Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
It's time for Yahoo Finance's Market Minute. Stocks are higher as investors digest President Trump's first wave of executive orders. Apple under pressure after Loop Capital and Jefferies downgraded shares of the tech giant, citing weaker iPhone sales and that AI didn't boost demand in the U.S. Netflix is set to report its fourth quarter earnings after market close. Wall Street expects strong results after a focus on live events and entertainment, including the Mike Tyson fight, NFL games during Christmas, and the return of Squid Games. And shares of Tempest AI jumping more than 30% to a record high. The medical AI company announced the launch of Olivia, an AI-enabled app that centralizes patient data. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth starts now.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the tools, tips, the tricks, and the resources that you need to grow your money. Hey, on today's show, it's President Donald Trump's first full day back in office, and he's been getting pretty busy, signing dozens of executive orders. We'll discuss how his new policies could impact the housing market, your taxes, and your budgeting. And are you curious about options trading? We break down the key terms that you need to know to become an informed options trader as part of our Options 101 series. Plus, we touch down in Davos, Switzerland at the World Economic Forum for an interview with the CEO of Williams-Sonoma. We'll hear how tariffs could impact prices on their products. All that and much more coming up during today's show. But first, let's dive in on some of the market action. We are 90 minutes into the trading day. Stocks rising one day after Donald Trump was sworn in as the 47th president of the United States. Joining me now, we've got Jeremy Bryan, Gradient Investments Senior Portfolio Manager. You tell investors to be careful with playing Trump trades. Walk us through that.
Yeah, for sure. Don't assume that just because something is potentially enacted or even enacted, how the stock market will react to that. And the classic example I give for this is energy. There's a lot of buzz around energy right now, right? Is that there's a national emergency for more production, that kind of thing, an executive order that came through. What I would say is that in 2016, during President Trump's first go around, there was a lot of buzz around energy there too. And what I would say is what was the worst performing sector during his presidency was energy. And the reason for that wasn't anything he had to do with, is because we suffered a global pandemic during that time. Secondarily, Mr. Biden, the president before or after Trump's first term, was considered pretty negative on energy. What was one of the best performing sectors during his tenure is energy sector. So you have to be careful in assuming that legislative or executive actions consider absolute positives or negatives on the stock market. That is why we always say just be cautious in making that linear adjustment and pivoting portfolios based upon those actions alone.
Certainly. And so all of these things in mind, what do you think will be the biggest themes that continue to play out over the course of the next 4 years based on what's been campaigned on?
Yeah, even based on what's campaigned on is what's going to work regardless of political action. That's kind of where we try to look at these things. And so from our side, we think cybersecurity. We think that is going to be a case whether there's executive actions, whether there's tariffs. One of the things we know is that cybersecurity, and especially with AI as a continued deployment going forward, cybersecurity is going to be either number one or number two priority for investment enterprise tech professionals. So from that side, that's where we would be leaning towards and saying that's an idea we can get our hands around and saying we think this is just going to be bigger over a longer period of time. And the way we're choosing to play that is Palo Alto Networks. We think that company is in the catbird seat with regard to what people need to spend more on, and especially businesses need to spend more on. So those are the kinds of things we're going to look at from the thematic point of view, is cybersecurity, and then AI pivoting from horsepower to software is another component that we're looking at pretty aggressively here, in saying that software deployment and efficiencies created via AI technologies is probably the next wave of iterations. And right now we're investing in the incumbents in there, and that's Salesforce and Microsoft. We think both of those companies are really going to be heavily involved in deploying AI services to their clients in ways that add value to their businesses. And so those are the themes we're really playing from our perspective and saying, regardless of what happens during the Trump trades or the adjustments that are happening in the White House, these are things that are going to be secular growth profiles that people will continue to spend money on.
You mentioned something interesting in, sure, there's what people are spending money on, but then there's also what businesses are spending money on. Cybersecurity aside, where are the other areas that you anticipate that businesses will feel comfortable continuing to deploy capital, even as we've seen them go through their own cost adjustment or expense adjustments in the recent 2 years, as all of the conversations around the dreaded R word and recession have been floating around, and businesses have been trying to make sure that they skirt any impact to themselves?
Yeah, from our side, we really don't see recession as a base case scenario, certainly. Could it happen? Absolutely. We don't see it as a base case scenario. So from our side, it's where our business is going to continue to spend to add efficiency to their businesses, because we also don't see, our base case scenario was more of a steady to slightly slowing GDP growth profile. Especially if we get fiscal initiatives that are government efficiency, if you will, the Doge of government. If that actually entails, that's a hard argument for us to say we're going to have accelerating GDP, because it's difficult to spend when the government is cutting back. So from that side, I think efficiency will be the bigger predominant of 2025 business spending, is how can I make myself still grow my revenue and still grow my earnings while being more efficient. So I think that from that side, it's whatever does bring that about. And so we're really looking at, from a company perspective, the recurring revenue stories, right? Is who gets money under just general circumstances, and it kind of just keeps coming in. And those companies are companies like waste management. We think that people are going to continue to spend on waste management, right? At the end of the day, you have to get your garbage picked up. So those are recurring revenue stories that have pricing power, that they can raise their prices and really doesn't change their business a whole heck of a lot. The other one we're looking at that we like a lot are the payment networks. Again, we think the consumer is going to be relatively okay. As long as jobs hold up, we think consumers will continue to spend. We don't see the current set of debt levels as red line territory at this point right now that's going to stop spending. So if they're continuing to spend, who benefits from that? That's Visa, MasterCard, because they run the rails of consumer spending.
Right. Jeremy, thanks so much for taking the time breaking down some of these picks that we're going to be tracking over the course of the year. We appreciate it.
Thank you.
Certainly. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host Shauna Smith here. And we got to start here with Tesla. It's been one of the top trending tickers on the site throughout the day. First up, Tesla reversing earlier gains after President Trump ordered his administration to consider eliminating subsidies and other policies that favor electric vehicles. Tesla and other EV makers falling today. You're seeing Tesla shares down by nearly 3%. Still, Piper Sandler raising its price target on the stock to $500 from $315, saying Tesla remains its number one buy and hold idea here. Want to get your takeaway from this, Shauna, even as we're tracking, of course, what is always a flurry of different headlines around Tesla.
Yeah, I think it's important to put this in context too, right? When you take a look at Tesla's chart over the last 6 months, this is a stock that has climbed over 70%. So we are seeing a bit of a give back here, not necessarily a huge surprise. We've heard a number of analysts on the street over the last several months talk about the risk here that we could see the incoming Trump administration, now President Trump, roll back some of these EV mandates, what type of risk this poses not only to Tesla, to the industry at large. Elon Musk even weighing in on this issue on a recent earnings call. He basically said that he does expect to see some sort of impact. He said, I guess there would be, when he was asked about an impact, but he did say that he did not think it will be devastating like it would be to some of the competitors. And I think that very much is also reflective of some of the sentiment out on the street as well. We've heard from Wedbush's Dan Ives numerous times talking about the fact that this could potentially be a huge blow to some of the other EV makers, to even some of the traditional automakers at large with their EV ambitions. But when you compare it to Tesla, given the market share, given the size, and given the fact that they don't rely as much on some of these EV incentives, that they will actually be better positioned, that it could actually help them in terms of maintaining that market share that they do have here in the U.S. down the road. So again, a bit of a give back here this morning. We are looking at losses of nearly 3%. But again, it's very important to keep in mind that this is a stock that significantly outperformed, especially when you take a look at that six-month chart with shares up just about 70%.
Yeah, going to be more noteworthy as well to see what some of those EV production targets are that get set for this year, after they fell short of some of the larger expectations, as Elon Musk had 2 million produced vehicles rattling around in the minds of investors and analysts out there last year. We'll see what that 25 goal looks like once we hear a little bit more from the company, once they report earnings. Next up, though, we got to talk about INTC. Intel raised to hold at HSBC. Analysts saying that the worst seems to be behind them for the chip maker, with the stock its price right now is it's pricing in recent uncertainties. They say the stock price at this juncture, though, up by about 2.4% at this juncture.
Yeah, I don't know if I'd take this as too positive. They say the worst could be behind it. They're not necessarily very optimistic about what the next several quarters, several months are going to look like here for Tesla. Remember, Pat Gelsinger resigning. Also, lots of questions about the strategy and what the evolution of Intel's integrated device manufacturing model, IDM, that 2.0 strategy that we heard from Gelsinger when he was CEO, but also what we have heard from Tesla, what exactly that looks like. HSBC did cite some of those uncertainties within this note. Also, this is a stock that has fallen pretty dramatically from those highs that we have seen. It's a stock that's down nearly 40% off of the peak that we saw going back to July. HSBC now seeing limited downside from these current levels. They're not exactly citing any sort of catalyst that they see on that near-term horizon. So again, they are upgrading this to a hold from reduce. I guess you can conclude that maybe the picture is improving a bit here for Intel, but they certainly have a lot of unanswered questions at this point, and many of those need to be answered before we see a more bullish call coming out from many of these shops.
Absolutely. Shauna, thanks so much for sticking around here, breaking down some of these trending tickers. In the world of options trading, well, guess what? There's plenty of unique terms out there. To help you cut through the noise, we're breaking down the basics and defining some of the most common phrases, sponsored by Tasty Trade. Joining us now, we've got Lucas Downey, co-founder of research platform Map Signals. Great to have you here. Let's start super basic. What are options and why are they something investors should consider? Let's just define that.
Brad, thanks for having me. Options are really what they say. They are options, and they allow you to make a view on a stock. And simply, when you think about options, you're basically buying the right or having the obligation to buy shares at a certain price at a specific time.
So another term that you hear when talking options as well, we know, are the options premiums. So what is the premium? Just break that down.
So options are not free. You have to pay for this right to buy something. Premium is basically the price that you pay for the option. How much is it going to cost you to put this option on?
And then there are two types of options generally here speaking, and knowing the two types, call options and put options. So let's start with a call option.
Yeah, so a call option, that is giving you the right to buy 100 shares of stock at the strike price at expiration.
And then the other type, a put option.
So a put option is the other side. So that is going to give you the right. So if you buy a put, you are basically getting the right to sell shares at a certain price up to expiration.
So what is the decision tree to know when you would want to trade on an options contract versus just buying, regular plain Jane shares of a stock?
Well, if you want to make a bet on where you think the stock is going to be. So if you're a trader and you're thinking, okay, there's this uncertain thing that's happening. Maybe it's earnings. Maybe it's worried about the Trump inauguration, right? Instead of going out and spending a lot of money and buying 100 shares of stock, you could put a fraction of that amount of money and have long exposure to the company through a call option. So really just comes down to how much risk you want to take and how confident you are in that trade.
Is there a good kind of rule of thumb or a threshold to know where you should be making sure that your return is perhaps going to outpace the premium that you would be paying for the option?
Yeah, and I think, as it comes to wealth and generating wealth, you probably want to be selling more options as opposed to buying more options. You can look at the volatility of that option, how much is actually priced in from the market, and that can really determine if an option is perceived as cheap or if it's perceived as expensive relative to itself, relative to history, relative to the market. So there's a bunch of factors, but I think at the end of the day, it's got to fit in with what you're trying to accomplish. So if you're selling options to earn premium, that's more of can be a longer term play. If you're really trying to take advantage of a short-term swing, really you want to be playing in cheap options in that type of environment.
Now, within calls and puts, there are a few different types of strategies. You mentioned cash-secured puts, for example. Explain that for us.
Yeah, so this is the way to think about it is a targeted purchase. So if you look at a downside put, if you were to sell that, you'd want to have a cash secured amount. So that way, if the stock actually closes at expiration below the strike, you want to be able to have enough money set aside to actually own 100 shares of that stock. So basically, you're basically putting money aside whenever you sell this naked put, so that if you are put in, that you're going to be able to buy 100 shares and not run into any problems.
Lucas, thanks so much for taking the time here with us today, breaking down some of these key terms. Appreciate it.
Thanks, Brad.
Certainly. Coming up, we're talking how home builders will fare under Trump 2.0 off of the back of results from D.R. Horton. That's next. Homebuilder D.R. Horton topped Wall Street's expectations in the latest quarter and reiterated its full year 2025 guidance. The company reporting net home sales decreased a little more than 1% year over year to just under 18,000 homes. Here for a look at what this tells us about the health of home builders and the housing market, we've got Alan Ratner, Zelman & Associates Managing Director. Alan, great to have you here with us. What do these results indicate to you?
Hey, Brad, good morning. Thanks for having me. Listen, the quarter itself was generally in line with expectations. If we kind of rewind 3 months ago, D.R. Horton, they're the largest builder in the country. They came out with a pretty tepid outlook for 25, generally a flattish volume outlook. declining gross margin. And I think that kind of set forth a sell-off in the home building stocks throughout most of the fourth quarter. This morning's release was generally consistent with that outlook. There were maybe some slivers of hope, which I'm sure we'll talk about in a second. But for the most part, you see the stock's reaction today pretty flat. I think that makes sense given the results.
Where do you believe those slivers of hope are in the housing market?
Well, there's a lot of discussion here. We're day two of the new Trump administration about what potential changes could come about from this new administration. I think a lot of the builders in the industry are optimistic about potential deregulation and what impact that could have on the cost of building homes and providing affordable homes to consumers. There are some potential negatives out there as well related to tariffs and immigration reform and potential reemergence of inflation. But the industry is somewhat optimistic that the deregulation will have a positive impact.
And so it falls in line with some of the key themes that your firm is looking at for builders in President Trump's second term, highlighting, as you mentioned, deregulation, mass deportations, and tariffs. And those policies, what do you expect the trickle-through effect, net negative, net positive, will be for builders?
Yeah, it's really difficult to say, not knowing really any level of specificity around these plans. I mean, on the negative side, we have tariffs, which anything that could add costs to building are certainly a negative. On the immigration side, it's unclear exactly how much labor is tied to illegal immigrants or just in general what impact any type of reform could have on labor availability. But the industry, for the most part, has taken a lot of steps towards bringing their supply chain domestically. They kind of went through this process during the pandemic. They went through it during Trump's first term. So there's not a ton of concern, at least in the industry right now, that there's going to be significant inflation resulting from this. But again, the real optimism, I think, could be if you could find ways to reduce costs associated with land approvals, entitlements, the development process, reduce some of that red tape. I think that could help add some supply. But our view on the margin is all of these things will generally wash out, and they're probably not going to have much of a net impact overall.
We'll get an update in a couple days from Freddie Mac on the weekly cadence, but it seems like, based on their most recent reading, that we've now seen the 30-year fixed-rate mortgage average above 7% once again. Do you think that home builders are going to need to go back to a stronger wave of mortgage rate buydowns?
It never really went away, but you're right. I think that the mortgage rate buydown has been such an important tool for the home builders to kind of bridge that affordability gap. We heard from D.R. Horton today. The number one thing they're focused on, regardless of what comes about from the Trump administration, is building affordable homes. And as an entry-level builder, they're providing homes with an average price in the $375,000 range. The typical new home in this country is closer to $500,000. And the rate buydowns are being offered on the vast majority of new homes being sold today. So, we hear that the consumer really needs a rate somewhere in the fives, not just to get them to pull the trigger, but more importantly, to actually qualify to buy that house.
We mentioned some of the key themes that you're watching that could impact home builders. What about home buyers, and what are those major keys to getting into the new home, or the keys to getting the keys, if you will?
Well, I mentioned affordability. That's the number one thing. I mean, we had consecutive years during COVID of home price appreciation that was well in excess of income growth. And then you layer on top of that more than a doubling of mortgage rates. And affordability is a huge challenge today. So anything we can do to improve that affordability equation, whether it's bringing rates down, buying rates down, hopefully it comes through the income growth side of things, and we have a still solid economy that can help bridge that gap as well. But really, that's what the consumer is most focused on. And unfortunately, the affordability backdrop right now heading into 25 is really not very favorable.
Alan Ratner, thanks so much for taking the time here with us today. Appreciate it.
Thanks for having me.
Certainly. Coming up, everyone, Yahoo Finance's conversation with Williams-Sonoma CEO Laura Alber at Davos. That's next when Wealth returns.
All right, lots of retail companies here at the World Economic Forum in Davos, Switzerland, and a lot of leaders, of course, of those retail companies are here at WEF. One of those leaders in the flesh is Laura Alber, Williams-Sonoma CEO. Good to see you again. Every year we do this.
Yeah, good to see you.
So there's no shortage of news in the world going on right now, of course, with the inauguration of President Trump. Let's start on your business, though. In terms of demand, what have you seen in your business, to kick off the new year, to the extent you can tell us?
Yeah, I mean, we're still in our fourth quarter and, haven't released earnings on the holiday yet. But I'd say we've seen sequential improvement this year, and that's not surprising to me. I mean, housing is not getting that much better, but certainly isn't getting worse. And so that's helpful to businesses that have correlation to that. And while that's not the only business we're in, and actually less than half of our business is furniture, it will definitely be amazing when that picks up. We've really, despite the negative demand that we've had this year, we've had incredible earnings, and we've really improved our op margin. And so, what I'm looking forward to now is, as demand continues to accelerate, and we hope even more so into the next couple of years, can you imagine what happens with the earnings then? Because we've gotten so much traction with our customer service initiatives in improving the customer experience that has driven earnings, but we haven't had that sales leverage yet. So,
what's the most important thing for your business in 2025? Is it housing activity picks back up, maybe with rates just a little bit lower, or is it consumers feeling better about themselves and they upgrade the furniture they have, and pots in their kitchen?
We never plan for the economy to drive our business, so I always plan it thinking it's the same, not worse, not better. And so it has to be our initiatives. And so our big message for 2025 and beyond is return to growth. I really think we're at the precipice of a very exciting growth cycle for Williams-Sonoma, and it's because of our initiatives. It's not because I'm waiting for something else to happen outside. It's because we have been working so hard during this time when things have been a little quieter on innovation. So innovation both in the product line, but how we sell the product. So whether it's in-store and our incredible salespeople using design services, or online, and we've got this whole suite of pretty spectacular design tools online that really help you complete whatever project you're working on.
I'm very lucky this year at WEF because I'm talking to 3 awesome retail CEOs, and they're all merchants. Gap CEO Richard Dixon, this is his first WEF, and then Ralph Lauren CEO Patrice Louvet. With tariffs in focus, do products have to be redesigned? Like, do you have to change how a handle is on a pot? Do you use different materials on a couch to save costs? Like, do you have to take it that deep, given what might happen?
It's different than that. I would say that, in the first Trump administration, we saw the first wave of tariffs, and we reduced our China exposure by 50%.
50%?
50%. So we are approximately 25% now. And we aren't waiting for the next wave of tariffs. We've been working to continue to move our product elsewhere. So whether it's elsewhere in Asia or even, in the United States. I don't know if you know, we have a very large, most of our upholstered furniture is made in Mississippi or North Carolina. It's a very large manufacturing unit, and it's been really a huge advantage in terms of made-to-order furniture fast for consumers, also very high quality. And our Rejuvenation brand, which is growing really fast, is in Oregon, and we assemble all the pieces there. So we're both moving away from China, but we're also working on improving our manufacturing in the United States and then in other countries. Most people, because we design it ourselves, when they have enough time, can hit our designs. And it's not a quick thing, which is why you have to be ahead of it. And so, this has been a big initiative, and I feel really prepared when this happens.
Do you have to raise prices?
I mean, I think there's always areas where we have incredible value, very innovative design, and we may raise prices. There's also the reality that we have incredible vendor partners who will help meet us on the tariffs, and because they want to keep the business. So there's a competitive nature to this. They don't want to lose the business. And we will work together to engineer products so that we can absorb some of the tariff. that way too.
Laura, of course, you're the longtime CEO of Williams-Sonoma, but you're also on the board of another company we know very well here, and that's Salesforce,
Yes.
led, of course, by co-founder Mark Benioff. We've seen a real pushback on DEI initiatives in this country. Can you take us inside some of these discussions at the C-suite? Are you still a big believer in DEI? Is it just having a moment? Will it come back? What's your view on it?
Listen, I think that, these names of things come in and out of style, but the most important thing is what your values are, and the values of performance and people and how people drive a business. And, one of the reasons I've been on the Salesforce board is because the values are so similar to my own and to that of Williams-Sonoma's, which is performance first. And that's not going to change. It's not going to change in either company, and both companies have done amazing things for the people that work there.
All right. Well, look, we wish you much success in the business in the year ahead. Laura Albert, always nice to see you. Williams-Sonoma CEO. Have a good WEF.
Yeah, thank you.
Appreciate it.
Thanks, Brian.
President Trump was inaugurated for his second term on Monday, and although he did not mention too much on taxes in his first actions, we know it's on his agenda for the year. Our next guest is here with 3 ways Trump could change your taxes. Joining me now, we've got Andrew Gordon, tax attorney, CPA, and partner at Gordon Law. Andrew, good to have you back on the program. Let's kick off with the first on your list, extending and expanding the Tax Cuts and Jobs Act. Tell us about that.
Yeah, thank you very much, Brad. It's great to be here. It's a very interesting time for tax policy now with the inauguration of President Trump. And the first big way that taxes can impact everyone listening today is through the Tax Cuts and Jobs Act. Now, the Tax Cuts and Jobs Act was originally passed back in 2017 during the first Trump administration. And the Tax Cuts and Jobs Act, or the TCJA, cut the tax rates across the board. So regardless of which tax bracket you were in, most likely you had a decrease in taxes after the TCJA was passed. However, it is set to expire in 2025. And so without action, your tax rates would actually increase. However, President Trump has vowed to extend the Tax Cuts and Jobs Act, keeping these tax rates, at least in the future, or hopefully permanent. The other big way is that the Tax Cuts and Jobs Act impacted those in high tax states even more because it had a limit on federal deductions for state income tax of only $10,000. President Trump has vowed to remove this limit. And so if you are in a high tax state, this could mean a much greater deduction on your federal tax return.
Next on your list under Trump, we could see the elimination of taxes on certain income types. So what exactly would that entail and ultimately mean for those specified income brackets?
Yeah, so on the campaign trail, President Trump had vowed to actually eliminate taxes for those that received income through tips, Social Security, and overtime. And so if you're in a service industry or a profession that generally receives most of your income through tips, this could mean that that tax is eliminated potentially in full at a federal level. Now, keep in mind, this doesn't impact state taxes. State taxes still apply, so if you're in a high tax state, you still have to consider that. But for those in service businesses and businesses that those that work for businesses that receive overtime, this again will mean a lot more income in your pocket. And another group that will be impacted is those receiving Social Security. President Trump also vowed to eliminate taxes on Social Security. So if these things go forward, it could mean substantial tax breaks.
And then lastly here on your list, Andrew, we're seeing the introduction of the External Revenue Service, which Trump did in fact announce Monday. Tell us what it can mean for taxes from your assessment.
Yeah, tax didn't come up too much during the inauguration, but one topic that did come up is the introduction of the External Revenue Service. Now, we're all familiar with the Internal Revenue Service, which gathers revenue or tax from internal businesses and taxpayers. But the External Revenue Service would collect taxes, duties, and tariffs from foreign sources, and specifically foreign businesses. And so imports will likely have an increase of tariffs of 10 to 20% on all imported goods. What this may mean, however, is an increase in costs for people making purchases, since there's now going to be an increase in tariffs on those deliveries. However, even the person that came on before me was speaking about how businesses may try to absorb those costs. So it's not necessarily a for sure thing that it will lead to an increase of consumer prices.
All right, let's change course here for a hot second. Stay with us, Andrew. We are under a week away from the official start of tax season, which means that your time is going to become a lot more scarce here. So we appreciate you taking some time ahead of it. We're also heading out of the holiday time when people may have received bonuses or raises. Talk to us about how tax brackets work.
Yeah, so one of the biggest misconceptions about taxes is that you have a fixed tax rate or that it applies to your overall income. But in fact, the U.S. is a progressive tax system, which means that there's different segments of income that's taxed at different rates. And so if you received a raise or bonus at the end of the year, your tax bucket may increase. You may be now pushed into a different bracket. And these brackets range from 0% on one end to all the way to 37% on the high end. So depending on your level of income, different brackets, different rates will apply. Now, two points to consider is your marginal tax rate, which is your tax rate on the next dollar of income you receive, and also your effective tax rate, which is your overall or average tax rate applied to all of your income.
So how do raises or bonuses affect your tax bracket?
So if you're currently in one tax bracket, that means that certain portions of your income are taxed at different rates, all the way up to a higher amount. But now if you receive a bonus or a raise, your income is now higher and you could be in a higher tax bracket. But what is very important to know is that the tax is only applied on the supplemental portion above the tax bracket. So for example, if you have a $95,000 salary and you receive a $10,000 raise, but the tax bracket is presently $95,375, for instance, you're only going to be taxed at the higher tax bracket, 24%, on the amount that's over $95,375.
So what should you do if you got a raise?
One thing to consider is making additional contributions into a tax-deferred account, an IRA or 401k, for instance. If you do this, you might not even have an additional tax from this bonus or raise. Another thing that you could do is actually ask your boss to pay that bonus at the beginning of the next year. By doing so, it will be in the following tax year, and you'll have the entire year to spread or increase your withholdings. So you won't just have a big tax bill at the end of the year, you'll have more time to pay it. Another thing that you can do is review your withholdings. Your withholdings is what is taken out of your paycheck every time you get payroll. But since you're in a higher tax bracket, you may need to pay more taxes overall. So it's a good time to review those withholdings so you don't get caught by surprise at the end of the year with a tax bill.
Thanks so much for taking the time here with us, Andrew. We appreciate it.
Thank you.
Certainly. Coming up, President Trump has vowed to address sticky inflation in his second term as president. We'll discuss what that means for your wallet after the break.
Over the past 5 decades, advanced micro devices, or AMD, has become a staple of the tech industry. Let's take a closer look at the semiconductor company's biggest moments with Beyond the Ticker. AMD was founded in 1969 by Jerry Sanders and a group of 7 other individuals. The company went public on September 27, 1972 at $15.50 per share, bringing in a total of $7.5 million. In 1982, AMD and Intel signed a 10-year technology exchange agreement as part of a deal to supply chips to IBM. In 1991, AMD released the AM386, its version of Intel's 386 microprocessor, leading to a legal battle between the two companies. AMD landed a major deal in 1994 to supply AM486 processors to power compact PCs, an unheard of move at the time. 2 years later, AMD purchased NextGen for $857 million in stock to take on Intel's Pentium line of chips. In 1999, AMD introduced the Athlon processor, the first 1 GHz microprocessor, and in 2003, the company launched its Opteron chips for network servers. AMD acquired longtime Nvidia rival ATI Technologies for $5.4 billion in 2006, pushing ahead into the graphics card business for high-end gaming and design PCs. In 2009, Intel agreed to pay AMD $1.25 billion as part of the pair's long-running antitrust battle. In 2013, Microsoft and Sony chose AMD as the chip provider for the Xbox One and PlayStation 4 game consoles. In 2017, AMD debuted its new Ryzen line of chips aimed directly at taking on Intel's top-of-the-line offerings. Then, in 2023, AMD acquired open-source AI software provider Nod.ai to boost its AI capabilities. Behind the AI wave, AMD hopes to continue riding this momentum well into the future.
A programming note: in this week's episode of Decoding Retirement, host Bob Powell speaks with Michael Conrath, who's the chief retirement strategist at JP Morgan Asset Management, about the precarious position Social Security is in.
Social Security is in a somewhat precarious state. And come 2034, as you indicated, that's when the trust fund is scheduled to go away. Importantly, though, what it does not mean is that Social Security in its entirety is going away. Yeah. So we don't have this 9 or 10-year clock on that. So it's zero. It's the trust fund. And that's an important distinction because let's just talk about some facts, Bob, starting off. The big reason why the trust fund is going down is because of demographic shifts. So we've had this large pool of the population that has been like the pig in the python, moving along, boomers aging, and we know all about that. So you have more and more retirees taking benefits than ever before, and that trend will continue.
You can catch episodes of Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. President Donald Trump promised to tackle sticky inflation in his inaugural address on Monday. Take a listen.
I will direct all members of my cabinet to marshal the vast powers at their disposal to defeat what was record inflation and rapidly bring down costs and prices.
So how can we expect new policies under Trump to impact your wallet? Joining me now, we've got Jade Warshaw. She's a master financial coach and debt elimination expert at Ramsey Solutions. Great to have you here with us. So you heard the clip here. What are your anticipations and expectations for how, even in the ambitious tackling of inflation that we know is also something that the Fed has already initiated their battle on, how that might play through to consumers' wallets and their strategies?
Good morning. Thanks for having me. You know, inflation continues to be an issue, but the truth is inflation has come down recently. And the truth is wages have started to outpace inflation. And so really, regardless of what takes place, because listen, inflation going down further is great for everybody. But at the end of the day, there's just these personal finance pillars that are important for everybody, no matter who's in office, no matter what inflation rates are doing, no matter what wages are doing. It's important to be a good steward of the money that you have in your, personal purview. And that really just looks like being a person who's always on a budget. That's part of how you handle money. You're a person who cares about getting out of debt and staying out of debt, right? You're a person who carries the proper insurances. You're a person who saves just for, emergencies and invests for the future. And of course, you're a person who's prioritizing giving. So if you're able to do all of those things at the right moment, no matter who's in office, you're going to be okay.
Some very sound reminders. We do know that tariffs are a key agenda for Trump. How do you see potentially higher prices if we do see this kind of spin out into a tit-for-tat type of trade and tariff war? Some products, they could see higher prices, and that might impact people's budgets.
The word tariff is a scary word, right? And especially when you consider the fact that the United States is the biggest importer in the world. There's a lot that is at stake there. There's a lot of prices that can be affected. Of course, number one, I'm thinking about oil prices, right? Crude oil. If that goes up, then we're going to see that reflected in gas prices. That's the truth. Foods, vegetables, fruits, things that are out of season that we want year round. Coffee. Of course, we could have the opportunity to see those prices go up because at the end of the day, if we charge more for those imports to come into this country, then those product makers are going to say, we've got to pass the price along somewhere. So of course that price is going to get passed along to the consumer. So we could definitely see that. Obviously, tech, that's always one that's a big import. So I do think that it has the ability to be passed on to our wallets. But at the end of the day, if we're looking at this and saying, okay, how can I budget for this? Then we're able to make those changes in our personal budget. And in 2025, I've been telling people, listen, you've got to know your numbers. You've got to know how much you earn. You've got to know what those expenses are. And then set your goals, set a clear goal and say, what do I want to accomplish in the face of whoever's in the office? Is it that I want to have 3 to 6 months of expenses? Is it that I want to start paying off debt? And then from there, it is you setting up that budget and starting to stick to it and being consistent.
I simply cannot pay more for my avocados at this juncture, Jade. It's just too much right now. While we have you, what tips do you have for financial success in 2025?
Yeah, like I said, it's all about getting clarity around what it is that you want to accomplish. So we want to set realistic goals. And I always recommend the baby steps. It's 7 steps that really show how to get on the path to personal finance, right? You want that peace with your money. And so it starts with getting $1,000 saved. So if you can get $1,000 saved, you're ahead of, 56% of Americans, because most Americans could not pay $1,000 for an emergency. So having that in cash is a big one. Baby step 2 is really paying off all of your consumer debt. So getting a hold on that. And then baby step 3 is about getting 3 to 6 months of expenses in place for an emergency fund. And they go on from there. But if you want more information on that, we're doing a free live stream. It's this week, January 23rd. We're going to be helping people set up their budgets, figuring out the next steps, how to get out of debt, and how to break the paycheck to paycheck cycle.
All right, some key tips just ahead of the start of tax season, too, while we're all doing this planning for the full year and trying to understand our impact here. Jade, thanks so much for taking the time with us. We appreciate it.
You bet. Thanks for having me.
Certainly. Let's do a final check of the markets here as we're taking a look at the Dow, the S&P 500, and the Nasdaq Composite. We're seeing fractional gains across the board, nearly full % gain for the Dow Jones Industrial Average right now. You're seeing the S&P 500 at this juncture, it's up by about 0.6%, and the Nasdaq Composite, that too is higher by about 0.3% right now. Seems like much of the activity here today is being led by industrials, more gainers than laggards here on the sector front. Well, that's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned with Yahoo Finance. We've got Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Welcome to a live special episode of Capital Gains, Yahoo Finance's unique look at how U.S. government policy could impact your bottom line. I'm your host, Madison Mills. We are in the studio today breaking down everything you need to know in Washington following President Trump's inauguration.
The golden age of America begins right now. I will declare a national emergency at our southern border to defeat what was record inflation and rapidly bring down costs and prices. We will end the Green New Deal and we will revoke the electric vehicle mandate. We are establishing the External Revenue Service to collect all tariffs, duties, and revenues. We'll establish the brand new Department of Government Efficiency. America will be respected again and admired again.
A busy day one for President Trump, signing more than 24 executive orders on everything from energy to immigration policy, with more orders still expected. We'll walk you through everything to know about Trump's day one and how it could impact the path forward for his economic agenda. But before we get into that, let me introduce my co-stars, Rochelle Akuko and Ben Werschgirl. Rochelle and Ben, welcome.
Hey there.
Hi, Maddie.
Great to chat with you guys. I want to start with you, Ben. We're in 24 hours now into this new Trump administration. What's top of mind for you?
Yeah, for sure. We are exactly, as we're speaking now, we are exactly 24 hours because he took the oath of office at about 12:01, 24 hours ago. And I have four things kind of we've learned about Trump these first 24 hours to kick us off. The first is, as you heard in that clip, a sort of a keen focus on two issues. This is something they've been telegraphing, but they went forward it. One is immigration. The second is energy. That was a big focus of Trump's early executives orders. And energy with the one, obviously, a keen of interest to investors, pushing really hard on opening up new areas for drilling, cutting regulations that Trump is going to keep on. He's going to keep on with more executive orders, and Congress is also going to address energy issues. The big question around that is whether oil companies need this. The oil prices are already kind of on the lower side, and they're projected to go even lower. So there's a question of whether oil companies will want to take advantage of all these new opportunities they're being given. The third one is tariffs. Trump he avoided big day one action on tariffs. His one executive order there was essentially to launch a review of trade practices. And that was the sense there from folks I talked to, was that this was a way to not upset markets on day one. But Trump being Trump, he couldn't kind of let the day end without making news on it. And he talked about how he wants to do 25% tariffs on Canada and Mexico on February 1st, which is just about 10 days away. So that's coming, and it's clearly top of mind for him. The fourth one, just to start us off, is TikTok. He unveiled a ban there to try to delay the app for 75 days. But what the overall message you got from Trump over this whole weekend was how close he is to TikTok. He's talked about a warm spot he has for TikTok. He talks about how young people liked him on that app, so he's a fan of it. So that's a big one with the TikTok CEO there at the inauguration as well. The overall sort of theme here, I think, to kind of tie these together and to pitch it forward, are lawsuits. All of these are kind of attempts to push forward presidential power, and all of them are going to face, in different ways, legal challenges. TikTok is a big one, but a variety of these issues are really legally questionable. So the question is kind of what does it look like going forward for Trump as he tries to move forward on these?
Ben, it's interesting that you mentioned Shochu. He was actually seated next to Tulsi Gabbard, who's Trump's national intelligence director pick. So interesting seating. And that really ties into this whole brocracy. We saw front row, all the tech bros, Elon Musk, Jeff Bezos. We saw Tim Cook seated, was also seated there as well. But we also saw Zuckerberg, Sundar Pichai. So imagine if you're the tech bros and you're front and center, you're in front of Trump's cabinet nominees. They were sitting behind them, and you even had some Republican governors, including Florida's Ron DeSantis, Georgia's Brian Kemp, some of these key swing state governors in the overflow room, not even in the back seat, but really in the overflow room. And we know that there does tend to be a lot of optics and showmanship. Everything is a little bit strategic in terms of how everyone is sort of seated and placed. So people are wondering, is this a sign that it really is going to be the sort of oligarch brotocracy that's really going to be informing the Trump agenda, which really isn't in line with the sort of K-shaped economy where people are saying, look, the people who voted for him, they're worried about inflation. They're worried about, the price of eggs. So it was interesting to see how that matches up in terms of the seating chart there. And look, people are saying this is what we ran on, right? This is what we voted for. We voted for the Trump agenda. I'm not sure that the tech brotocracy is what they had in mind when they were trying to, get their grocery list together.
Yeah, I think it's such a great point, Rochelle, especially in the context of Trump 1.0. We saw how long individuals close to Trump lasted. And Bradley Tusk, a venture capitalist, joined me this morning for a conversation on this. And he said, ultimately, what Trump wants for his agenda is what wins. So don't read too much as an investor into something like Meta CEO Mark Zuckerberg being in the room. If Trump wants a certain policy, like, for example, the pausing of the TikTok ban to endure, he is going to go with what he wants, not necessarily with what the tech CEOs in the room might want from him. Having said that, I also want to talk a little bit with both of you about his immigration policy. This was something he clearly was very focused on day one, issuing a slew of executive orders on immigration. And he specifically talked about a few different things, obviously declaring a crisis at the border, but also revoking birthright citizenship, which we know is protected under the Constitution. So that's been something that leads to this question about the longevity of these executive orders. But this morning, we've been talking a lot about this specific comment he made on legal immigration. Take a listen.
I'm fine with legal immigration. I like it. We need people, and I'm absolutely fine with it. We want to have it. We need it because we're going to have a lot of companies coming in to avoid tariffs. We have to have legal immigration.
So I spoke with an immigration expert about that line this morning, and I asked her, do you buy this idea from President Trump that legal immigration could be used as a backfill for any job loss that is created due to new policies on immigration? And she said, look at the Trump 1.0 agenda to get clarity on that. He said very similar things back in 2016, and then we did not see a huge move to the upside on legal immigration. And that really clarified things from my perspective about how we should be looking not only at his immigration policy, but also just more broadly at the commentary coming from this administration, and the market reaction to that perhaps should be considered a little bit more widely moving forward here, as opposed to just kind of moving based on every single individual thing that Trump says. But I'm curious what you guys think about that. Ben, what do you think, given your reporting in DC?
I mean, I think the question that raises for me is does this brotocracy let him downplay that issue at all? I mean, I can tell you maybe Trump sort of doesn't have super strong feelings on H-1B visas, but I can tell you Elon Musk does, Mark Zuckerberg does. So that's a key difference, between Trump 1.0 and Trump 2.0, is that these guys have incredible power there, and they have shown the ability to kind of get heard by him and get him do it. I think, there's going to be a split screen. We've already seen it during the transition, and I think it's going to continue, where harsh action on illegal immigration. One of the big things that Trump announced yesterday was troops at the southern border, which is, I think, what we're going to see soon, along with this kind of trying to toe the line on H-1B visas that Musk is not going to let him kind of fade away for certain.
And it's interesting because I did run some of the numbers in terms of the number of mentions through Grok, that's X's AI, tried to keep it as neutral as possible. And in terms of the mentions within the signed executive actions on day one that Trump had, topping the list in terms of ranking based on the emphasis and frequency of mentions when it comes to topics, immigration and border security far and above had the most mentions, including that national emergency declaration at the southern border, an attempt to end birthright citizenship, etc. Second was environmental and energy policy. We heard drill, baby, drill. We heard, we actually saw in a lot of the executive action that was revoked from the prior administration, a lot of the ones tied to climate risk, not just the Paris Accord, but also financial risk tied to climate. You also had government operations and federal employment. Obviously, the hiring freeze, having the federal workers return to work. But I wonder, when you look at those top three things, what you don't hear is the economy. That actually got much fewer mentions than those other three. It was very light on details. It was about sort of marshalling the cabinet to figure out how to do it, to figure out how to help with the cost of living crisis, which is what people said that they voted for him for. But we didn't see that. But we did see a lot when it came to immigration and border security, both during his inauguration speech and a lot of the cheers that he got as well, and a lot of the cultural and social issues. But it's hard to determine which of those are actually going to help bring any prices down, manage inflation, or give people the economy that they think they're now about to get. Keeping in mind, the economy is not in bad shape. I mean, the economists that we've been talking to, that they say the US economy has seen stronger recent growth in real GDP, productivity, real wages. You've got a low unemployment rate, inflation moderating, although ticking back up a little bit in January, moving towards the Fed's 2% target. But that does speak to that K-shaped economy. If you don't feel like you're doing well and only sort of the top 1% are doing well, overall, the numbers look like the economy's doing well, but if you don't feel like it's doing well when you're trying to pay your bills, get your food, put gas in your car, that's really what the voting comes down to.
And it's been fascinating to see consumer sentiment data that I know you all have talked about on the show so much, where Democrats and Republicans have completely flipped in terms of inflation expectations. Prior to the election, Republicans thinking inflation was going to be higher for longer. And after the election, that's flipped, and Democrats now leading to that inflation outlook. I do quickly want to mention energy. Trump declaring a national energy emergency yesterday and issuing some executive orders to that end. But it's interesting in the context of U.S. oil production. We heard Trump saying drill, baby, drill in the U.S., and he is efforting that in attempts to get oil costs down, which would, in his view, prevent some of the inflationary pressure that we have been seeing. But you can see on this chart here, the U.S. is already at peak oil production and has consistently over the past decade or so been trending in that direction as the top oil producer globally. So what will increased oil production actually do to the price of oil and the oil market more broadly is something that we will, of course, continue to monitor here at Yahoo Finance. We do have to take a quick break, but we're going to be right back with Henrietta Treyz and more capital gains after this. Welcome back to Capital Gains. We are now joined by Veda Partners Director of Economic Policy, Henrietta Treyz, as we track President Trump's initial agenda at the White House. Henrietta, the market is keenly focused on tariff policy, and we're seeing a bit of a relief rally in the market given the lack of any sweeping tariff policy, at least on day one. What are you telling clients about what's coming next on tariffs?
There's actually a series of events that we're about to see on the tariff front. In the first place, the idea of universal tariffs that you might have expected on day one is not consistent with Trump's first term. It's not consistent with the sort of novel approach that we saw from USTR Lighthizer in his first term. And of course, the incoming USTR is Jamison Greer, who was Lighthizer's chief of staff. So we're seeing a really continuation of the first Trump term, which is a nuanced approach using almost exhaustive trade remedy authorities across Section 232 national security tariffs, which we're expecting in the months ahead, starting with the EU as early as April 1st, given their March 31st expiration. A balance of payments authority, which allows the president to put 15% tariffs on any nation in which we have a balance of payments deficit for up to 150 days. An additional review of the Section 301 tariffs against China, including pulling out of the Phase 1 trade deal, which would escalate tariffs across what is currently about $350 billion worth of goods and could expand. And then, of course, IEEPA tariffs with Canada and Mexico that he sort of off the cuff threatened to impose on February 1st, and historically usually has a lag time of 10 days before implementation. So I think a lot is coming, and this is all a very exhaustive, very by the books way to implement trade strategy.
Hey, Henrietta, thanks for joining us. Curious one aspect of what you just mentioned there, which is something we've been talking about on this podcast for a while, which is why is Trump so obsessed with Canada? That's something we didn't hear during the campaign, and then sort of immediately afterwards, these Canada-Mexico tariffs. We saw it last night in these off-the-cuff comments you referenced. What are you telling clients on that? Why is Canada and Mexico as well in such a focus for Trump?
So I think in the first place, the Canada and Mexico approach is really about the USMCA renewal that's due in about 18 months, midway through next year. We're effectively setting the stage now. Some of the issues we have with Canada involve, of course, immigration and fentanyl, which is what the IEEPA tariffs are about. But the USMCA renewal, and let's remember that USMCA was the hallmark of his trade agenda outside of the U.S.-China trade war in his first term. That is going to revolve around issues around lumber and dairy. And he has similar issues with Mexico when it comes to investment in from China into the nation. So I think a lot of this is actually gearing up to prepare for pretty robust renewal negotiations on the USMCA.
And Henrietta, good to see you, Rochelle, here. I want to ask you about the first 100 days. When you're looking at the different options in terms of tariffs, whether it's the USMCA, whether it's the US and China and the Phase 1 trade deal, obviously that it's still kind of stalled, the EU, what do you think is going to be the most significant of those within the first 100 days?
First 100 days is a good starting place. I mean, I think we have to probably expect something on Canada and Mexico, at least in terms of massive headline risk around an IEEPA threat. And this 25% rate, I think, is really high historically. Back in May of 2019, the rate that he would have started the Mexico tariffs at was 5% and eventually land at 25% a couple months later in October of that year. So I think 25% is high. I'd watch for that number to come down. But obviously, February 1st is something that he's looking at announcing something on IEEPA with Canada and Mexico. So that would be the first thing. We also need to be mindful that his USTR, Jamison Greer, and Commerce Secretary are going to have to go through their nomination hearings. And those are going to be flashpoints where the U.S. senators, particularly from the Republican Party in these farming states, try to hold those members' feet to the fire and say, hey, be mindful that when you impose the tariffs, the retaliation is going to hit our constituents, mostly farm states in red states, from North Dakota to Alabama. So a lot of those issues are going to be front and center when we go through this nomination hearings in the next couple weeks. I think March 31st is critical to recall that the U.S. and EU have real tensions, and the EU is not negotiating with the United States, and it didn't under Biden either, to alleviate issues from steel and aluminum, which is what the tariffs are theoretically for, but really also their agriculture purchases and most pressingly their auto industry. And the fact that these high quality, sort of like high skilled labor components are made over in Germany and not in the United States. You hear President Trump himself talk about that with incredible depth for a trade issue to talk about how upset they are at the fact that we're effectively, a building shop where we put the hood on the car and the doors on, but they make the batteries and transmissions and all those high tech, sort of high skilled labor jobs they want here. And then finally, the China front, indications that we're going to start negotiations that have a 10, 20, 45-day allotment under the enforcement mechanism of phase one. So really everything is on the table, and I expect to hear all those pieces in the next 100 days.
And just quickly, do you think markets are pricing that in, or when will they start pricing that in?
I think markets are acting irrationally by being so excited that tariffs were not announced on day one. I think that's something that we should have forecast, should have understood. Universal tariffs are not a good way to implement trade policy, which is why they didn't do it in the first term. And, Lighthizer and Jameson Greer are very close, and it's appropriate to expect a continuation. So just because tariffs didn't happen on day one should not make anybody comfortable. The America First trade policy agenda that had various dates, key agency officials targeted, addendum after addendum, suggests that all this trade stuff is coming. The formation of the External Revenue Service alone should be cause for concern. I mean, my focus is on taxes and deficits at my core, and we need this revenue in order to offset the cost of the tax bill, or at least give the impression of paying down some of the cost of the deficits that will have to be incurred by writing a tax bill in 2025. We got all year to pay for this. It's going to take 4 years to collect the revenue at a minimum. This is going to be a long-standing threat for the investment community.
Yeah, Henrietta, talk to me about your thinking on that creation of the External Revenue Service. Do you think that is sort of a branding tool to help this administration communicate revenue that could be used to tackle the debt ceiling, or is it something else?
I'm going to have to steal that language, Madison. That's exactly correct. Yes. We obviously already have a tariff revenue collection agency, Customs and Border Patrol. So this is a new line item, effectively, that would be really easy to read if, implemented as the president has sort of laid it out. You have the IRS that collects domestic revenue. You have the External Revenue Service that collects tariff revenue. And then instead of getting an overview from, CBO later on in the year, Treasury, about where we stand on all those agencies and the revenue they're collecting, you have a very specific line item that says External Revenue Service collections. Again, this all goes back to the fact that extending the tax cuts that he passed in his first term will cost over $5 trillion. That's not even including the limitation on the cap for salt that's going to have to be adjusted, or the proposal to provide tax-free taxes on tips, or Social Security and Medicare payments being tax-free. Those are massively expensive items. And the Republican conference in the House barely has a vote to spare on these super contentious items. So the issue of reducing the deficit, or the appearance of what the deficit is going to be when they pass an extension of the tax bill, is paramount. It is the story of 2025. It really is the story of tariffs, taxes, your SALT deduction, the IRA tax credit. The whole story revolves around deficits. And you can have the External Revenue Service with a specific line item that says, hey, we're on track to generate $1 trillion. The Republican members of Congress can point to that later on and say, look, we found the money. And it'll be really easy to read.
Henry, what are you, obviously on this largest fiscal debate we're having, Trump is going to meet with lawmakers this afternoon on this, and this 1 versus 2 bill question that you referenced is still up in the air. What's the latest you're hearing on that? How likely are we going to get taxes sooner, or is this going to be an end of the year as a lot of people are expecting?
It's my ongoing view that the tax bill will not pass until it has to, which is December 30th, 2025. We don't pass big legislation on taxes typically until like the second or third week of December. You can go back all the way to 2010 when we were dealing with the Bush tax cuts. If I'm not mistaken, that bill passed December 17th. The last couple passed December 22nd. This is a late in the year issue. My odds are pretty aggressive on this front, but that's how I like to roll. We're at 80% that we are going to have 2 reconciliation bills. The first one, incidentally, has a completion date of around April, which is right when Trump is tasking his Commerce and USTR secretaries with identifying the state of play on phase 1 and Section 232 and all those tariff remedies. That would be the Senate's preferred path, the House Freedom Caucus's preferred path, and the House Republican Study Committee's preferred path. And that creates a bill and a deliverable for Trump on border spending, military preparedness, and energy permitting and leasing in the first 4 months of his term. That's the fastest you can hope to pass any legislation. We'd see the budget on that probably in February. Then a second bill would be written late in the year with the fiscal year 2026 Budget Resolution Authority authorizing reconciliation. We'll see if they can pass the bill with just partisan support. Part of that will depend on the revenue coming in from tariffs and the debt ceiling. And they'll do that in the back half of the year, starting around April, May, and lasting probably through December for that to be.
And I know that you said that tariffs are going to really be the defining moment of this administration. Is there anything that we're not paying attention to that we should, perhaps things that aren't being discussed that are really also of the most importance for investors?
That's a great question. It's very fair. Honestly, I have to keep coming back to trade and tariffs. And the reason is Congress is only going to be able to pass legislation this year. After 2025, we're going to be neck deep in the 2026 midterm elections. There's going to be aggressive primary races and then a general election cycle that's going to imperil a number of Republican senators. I would say Susan Collins of Maine, who may announce her retirement instead of seek re-election. Tom Tillis in North Carolina, a state that, as you referenced before, so much of the money from the IRA goes to these red states where there is a growth in clean energy, have a real problem repealing those IRA tax credits. So the reason that investors should focus on tariffs and trade is because it's entirely implementable with just the executive branch. We do not need Congress to weigh in on tariffs or trade. So just like in Trump's first term, where we spent the first year legislating with the health bill and the tax bill, that's going to happen this time around.
Really important context, as always, from you, Henrietta. Thank you so much for making time with us to break down the initial thoughts on the Trump administration under Trump 2.0. We appreciate it.
Thanks for having me.
That's going to be all for this episode of Capital Gains. Thank you again to our guest, Henrietta, and also our co-hosts, Rochelle and Ben, for being here. And thank you to our audience for joining us. Make sure to like and subscribe to Capital Gains wherever you get your podcast, and we'll see you next time on Yahoo Finance.